meeting of the
Recording in progress.
Federated City Employees Retirement System. We will call the roll. Vice Chair Chandra.
Present.
Trustee Abbott.
Here.
Trustee Avasti.
Here.
Trustee Faulkner.
Here.
Trustee Linder.
Here.
And the chair is here.
We need to qualify Vice Chair Chandra under the Traditional Brown Act teleconferencing rules.
Yes, please proceed.
Vice Chair Chandra, you are appearing by the Traditional Brown Act teleconferencing rules. Are you teleconferencing from the address 45000 Indian Wells Lane, Indian Wells, California, 92210?
I am.
Is the location from which you are teleconferencing ADA accessible and open to the public?
Yes.
Have you posted the agenda on the exterior of the location where you are teleconferencing from so that it can be seen by members of the public?
Yes.
If any member of the public wishes to be heard by the board from the location where you are teleconferencing, can they be heard?
They can.
Vice Chair Chandra is qualified under the Traditional Brown Act's teleconferencing rules to participate in today's meeting. Just as a reminder, all votes today need to be taken by roll call vote.
Thank you, Council. We do have a change in the agenda order. Consent calendar will be heard first. That includes item 1, which is a rescission of application for a change of status. And are there any other requested changes to the orders of the day? Seeing none, we don't need to vote for that. Okay. We do not need to waive sunshine. At this point, I will take public comment on any item that is under the jurisdiction of this board, which is not otherwise on today's agenda. Is there anyone who wishes to speak in general to the board? Seeing none, we will proceed with the agenda. And then the first item, as mentioned, let me just also mention that we have a time-certain item today at 10:30, which is the interviews for the open trustee position. So that will be taken at 10:30, and I plan to take a break, a 5-minute break at 10 o'clock. So item 1 is the rescission of application for change of status to a service-connected disability retirement. Staff recommends the board acknowledge and accept the withdrawal of application. Is there any further background on this item?
The only thing that would be pertinent is this member was one of the members that we discussed concerning workers' comp.
Okay. Any questions from trustees? Any public comment? If not, I will entertain a motion then to accept the rescission of application. Do we have such a motion?
So moved, Mr. Chair.
Thank you.
Second.
From trustee, a motion from trustee Linder, second from trustee Faulkner. Any further discussion? Seeing none, we will have a roll call vote. Vice Chair Chandra.
Aye.
Trustee Abbott.
Aye.
Trustee Avasti.
Aye.
Trustee Faulkner.
Aye.
Trustee Linder.
Aye.
Chair votes aye. We will now have the consent calendar, and we need a motion and for consent calendar. Do we have a motion to accept the consent calendar?
I move we accept the consent calendar.
Thank you. We have a motion from trustee Linder, second.
Second.
Second from trustee Abbott. Any further discussion? Any public comment? Seeing none, we will vote. Vice Chair Chandra.
Aye.
Trustee Avasti.
Aye.
Trustee Abbott.
Aye.
Trustee Faulkner.
Aye.
Trustee Linder.
Aye.
Chair votes aye. Moving forward to agenda item number 3, death and survivorship. We will have a moment of silence for those who have served the city and who have passed. Thank you. We are now on to item 4A, which is an oral update from our CIO, Mr. Plani.
Thank you, Mr. Chairman. Good morning, trustees. We have somewhat of a longish agenda today with performance reporting and pre-funding, etc. But we will try to go through it as quickly and efficiently as possible. And before I start, fiscal year to date, as of Tuesday, the pension plan was up 3.94%, and the healthcare trust was up 4.82%. And I also want to welcome Jennifer Yu to the investment team. Jennifer is our operations manager, takes over from Ron. Ron has moved to a risk and compliance officer role within investments. Jennifer is a CPA, was with the airport authority, so city employee for 7 years, and also worked for the big five, big four, I don't know if they're big three now, KPMG. So welcome, Jennifer.
Okay, thank you, and welcome.
With that, unless anybody has questions, we can move to pre-funding 4B.
Okay, are there any questions from trustees? Any public comments? Okay, let us proceed to 4B.
Thank you.
Morning. So you may remember that this is the time of the year where the city as a sponsor gets to determine the frequency, or the timing rather, of their sponsor contribution. I'm going to be super brisk here because the city has already decided not to pre-fund Federated. You may be asking, why should we give me an opportunity to do this whole presentation? I would say process for the sake of process is not my favorite thing, but we want to be consistent in our application of the discount setting methodology because it allows the city to plan ahead, right? And so we ran this item by the investment committee not too long ago. It was recommended that you all as a full board adopt the staff's recommendation. But just to go over things very briefly, you'll remember that the Muni Code lays out the roles and responsibilities of the board as well as the city in determining the discount rate and how that sponsor contribution frequency gets set. So the city as a sponsor gets to determine the timing of their payments, but you all as a board get to determine the discount rate that's applied to that calculation, as long as whatever rate you calculate results in an actuarially equivalent payment to the default timing, which is just every 2 weeks. So we as staff put out a methodology beginning maybe a decade ago, and it's been revised since, but the discount rate setting methodology has a few different components in it, including how long it's been since the recession, how long it's been since a market pullback, et cetera. According to that methodology, there should be a small haircut in the discount rate offered to the city this year of 15%. So that's 15% of the 6 5/8. Remember, a smaller discount means the city has to pay more. Again, we were notified by the city that they're choosing not to pre-fund Federated again this year. But it would be nice if you all as a board, approved staff's recommendation again for the sake of consistency, so that next year, when we get back to this item, we're able to say that staff's recommendation, has been in place for a decade plus now, and everybody knows what to expect from the process.
Okay. Are there any questions from trustees?
I have a question. Can you explain the main factors that are driving the reduction?
I'm sorry, one more time?
What are the main factors which are driving the reduction? What is there in the methodology which is driving the reduction in the discount?
Sure. So the methodology has 3 components. One is the amount of time since there's been a recession, and we're using the it's an NBER, to determine what an actual recession is. The definition is maybe a little bit fuzzy. So the methodology says there's 3 possible triggers for reducing the discount rate offered to the city. One of those triggers is how long it's been since there's a recession. The second is how long it's been since there's been a market pullback, and I believe it's defined as 30% or more from the high for the S&P 500. And so if it's been a really long time since 30% drawdown, then we'll start reducing the discount rate as one of the triggers. And the third most recent trigger is evaluation of the S&P 500 using the CAPE ratio. So it's a long-term cyclically adjusted price earnings. And that's just to introduce this idea of, okay, maybe it hasn't been long enough since a recession or a market drawdown, but for some combination of factors, some reason the market is really overvalued. That would be the third trigger. And so we have those 3 different avenues for reducing the discount rate from the default 6 5/8. The first year, if one of those triggers is hit, as it is this year, the valuation trigger is hit, we'll reduce the 6 5/8 by 15%. And again, smaller discount offered to the city means they have to pay more. Next year, if trigger is hit again, then we would take another 15% reduction. And looking ahead, maybe 2 years from now, if another trigger is hit again, so 3 years in a row, the maximum reduction in that 6 5/8 would be hit of 45%.
And so what we're doing here is gauging the pre-funding to where we feel we are in the business cycle. That is the global effect of these 3 trigger points.
Right. You could call it. We're trying to price, in some sense, the timing risk associated with the sponsor making the contribution up front as opposed to throughout the year. So let's say, worst case, they make their payment on July 1st, the first day of the fiscal year, and July 2nd, something really bad happens to the market. The portfolio now is on the hook for that bad event happening to that entire lump sum, as opposed to having kind of dollar cost average into it throughout the year.
Mm-hmm. So the alternatives are pre-funding the entire amount or equal amounts throughout the year on a monthly basis. Is that correct?
Yeah, they can actually choose the frequency, so it could be monthly. Right now, the default is with payroll every 2 weeks.
Every 2 weeks. And so the net effect would be if we were in a year that was right after a recession or a drawdown or some of these other trigger points, the incentive to the city would be greater for them to pre-fund so that we could invest earlier in a recovery cycle. That would be the net effect of this system.
If we were in a year right after. Yeah, it's not designed so much to incentivize the city as a sponsor. I think of it as kind of, since we get to set the rate, you all as a board get to set the rate, you're trying to find the rate that makes you indifferent between the city pre-funding or paying throughout the year. And so you're trying to price that kind of risk. The city will say, usually they'll make their decision on the amount of budgetary fiscal savings that they can reap from the pre-funding.
Mm-hmm.
Which is lesser if the discount rate is lower.
A simpler algorithm from the approach of the city. And in fact, what is the history? How often have they chosen to pre-fund? Have they ever chosen to pre-fund?
Yeah, so if you go back, if you go back a few years, they had been pre-funding Tier 1 for Federated as well as Police and Fire. The past couple years, it's been Police and Fire Tier 1 only. And that, I think we've discussed this before, but I think the rationale is the money for the contribution comes from different accounts within the city budgeting. And the P&F comes from, I think it's a general fund, as opposed to Federated. It's distributed throughout. They have more cash in certain pockets than others, I think is the way it goes. And the cost of funds to the city to borrow at this point doesn't make it economical to say borrow up front and pay the contribution for what the discount rate is set at.
Okay. Any further questions or discussion? So if not, if there's no further public comments, I'll entertain a motion to, oh, there is a comment. Okay, if there is a public speaker online, please proceed. You have 2 minutes.
Good morning, Chair Horowitz. My name is Brad Imamura, and welcome to our new Council Representative, Vice Mayor Foley. I don't see her logged in, so if you can indulge me, Mr. Chair, I was having some technical issues, couldn't make my general comments at the beginning. I just have a couple items I wanted to address, and again, I wanted to extend the invitation to any and all board members to meet with the public, specifically myself, to those you are entrusted to serve. And again, I reach out to you, and I know you've been very stoic about wanting to meet. I understand that 4 of the board members are scheduled to attend a conference in Half Moon Bay. My question to the, and also I see Mr. Polani is a speaker at the, I believe it's called the Pension Bridge. It's a nice location at the Ritz-Carlton, right on the ocean in Half Moon Bay. Anyway, to the council, are you concerned about possible Brown Act issues when you have a quorum of the Federated Retirement Board attending at one meeting? And if you can address that. Again, this form of communication is very awkward. It's like I'm speaking to a wall. I don't get any feedback or comment, and lots of times my questions are not even answered. So again, thank you, Chair Horowitz, for allowing me to speak. And also, I would like to speak on an item on your agenda. I think it's coming off a time certain at 10:30. Item 6C.
Okay,
Thank you.
we will, thank you, Mr. Memora. We will address that agenda item later. I believe there is a carve-out in the Brown Act for common attendance at seminars and trainings. Can you enlighten us as to the specifics of that, Council?
Yes, the attendance of the board members at a particular conference itself does not trigger the Brown Act violations. It's only where the members in attendance that do meet a quorum discuss matters of the board's business together in that forum. And so the conversations, for example, if there's something agendized or something that would be brought forth before the board for consideration, but the board has comments and discusses that at the conference outside an agendized meeting, then that would cross the line. However, attending an educational session in and of itself and not discussing matters directly before the board does not violate the Brown Act.
Thank you for that elucidation. Okay, any other public comments? Seeing none, we can proceed to the, oh, I'm sorry, we didn't have a vote on pre-funding.
Yeah, I guess we can, it's academic, but.
It is academic, but let us.
It does say action, so yeah.
If it says action, we're going to take action. I would entertain a motion then to accept the pre-funding offer to the city.
So moved, Mr. Chair.
Thank you. From Trustee Linder. Do we have a second?
I second.
We have a second from Trustee Abbott. Any further discussion or comment from trustees or the public? Seeing none, we will have a vote. Vice Chair Chandra? Trustee Avasti?
Aye.
Trustee Abbott?
Aye.
Trustee Faulkner?
Aye.
Trustee Linder?
Aye.
And the chair votes aye. Thank you.
Thank you, Jay. On to 4C, I'll introduce the item and then Laura will talk about it. Discussion and action on strategic asset allocation by Makita. I guess the wording should be discussion on capital markets assumption as opposed to strategic asset allocation, but I think they're both.
They're part and parcel,
could
but.
be
yeah.
synonymous, but
Mhm.
I just, look, I want to preface this by saying that I want trustees to keep in mind that this is strategic, this is not tactical. If anybody wants to make tactical decisions, I'm happy to consider those and we can talk about it here. or at an IC. So always keep in mind that we are long-term investors. Our horizon is, 20 years. Longer, very few pools of capital have this kind of luxury. And also want to remind everyone that inaction is very strong action. So one does not need to feel obligated to act because it's in front of you. Did I show my hand by making those comments? Perhaps I did.
I think you're leading the witness a little bit, yeah.
Okay, all right. With that, I will turn this over to Laura.
Thank you. Good morning, members of the board. Happy first day of spring. I'm Laura Wyrick from Makita Investment Group, and my computer is frozen, so I'm not able to move from the slide. Luckily, this is a very important slide, and hopefully it catches up in a moment. I'll talk first about our capital market expectations, which is the first 36 slides of this presentation. It's an academic presentation, and it's something that we discussed in detail with the joint IC 2 weeks ago, along with members of Makita's capital markets global macroeconomic team that develop our capital market expectations. My colleague Zach Stevens is on the line as well in case of questions on our expectations. I'll mention, Makita, in developing our 10 and 20-year expectations, which we do annually, we use year-end data. So all of the data that we put into our model is from, widely available sources, the IMF, the World Bank, Bloomberg, other data providers out there. We use all that information as of December 31st of each year, put it into our various models that we've developed over several decades. And we know that the outputs are not going to be exactly correct. No one can tell us exactly what U.S. equity is going to return for the next 10 or 20 years, and if we could, we'd, probably not all have day jobs. But that said, we do think it forms, an initial basis for informing asset allocation, and it is something that we review annually with our clients when we update those expectations. I'll also mention that, Makita develops these expectations, so do many investment banks, other consultants. Makita doesn't buy or sell securities or manage any funds that institutional investors can invest in. We're purely an advisor, and therefore have no interest in sort of inflating one expectation for an asset class relative to another, whereas somebody that's, selling new products, a large bank, might have an interest in having a certain expectation be higher or lower than another. So we're really quite indifferent to the output, other than trying to be as accurate as we can be. So the first 36 slides of this presentation center around what our expectations are and how we develop them. And we know that most of you have seen the development process in the past. And so hopefully let me try stop sharing here and see if it will advance. In that case, it just seems that it's completely frozen. Is there any way that you all might be able to pull it up and I could refer to a couple of slides? Okay, I am actually able to see it here, but not in the one that is shared. So on page 37 here, we have the output of your current allocation on the left, the Federated pension asset allocation. So you can see on 37, 75% in growth, 8% in low beta, and 17% in other. So these are the functional asset allocation categories. And we estimate that the expected return on an annualized basis, so average annual return per year, over the next 10 years for your asset allocation would be approximately 7.2% per year. Over the next 20 years, 8.6%. You do look at standard deviations from Veris, because Veris is your risk consultant, and so they have calculated the standard deviation for your current pension allocation at 11.5. You can see the last line here is the probability of achieving your actuarial assumed rate of return over the next 10 and 20 years. Both of these are well above 50%. We also wanted to show you another asset allocation. As your CIO mentioned, we think the default, assuming no major market corrections, is to stick with the current one and reevaluate more fully every 3 to 5 years. Typically, the most successful investors stick with a broad asset allocation over some number of years. But we did want to show you an asset allocation that has more fixed income. When we look at our capital markets expectations, fixed income is the asset class that we do have higher expectations for going forward. The forward-looking interest rates are higher than they have been in the past, and therefore we expect fixed income to yield more. You can see here that the Fed more fixed income allocation, the one, let's see, if we go back one slide, the one on the right here, thank you, has a little bit less in growth, so it would be 72.5% in growth, taking 1% out of U.S. equity, 1% out of developed markets equity, and 1% out of emerging markets equity, and would shift that with 1% going to high yield bonds, into below investment grade bonds, and then the other remainder of that shift, 2.5% going to investment grade bonds. That would leave your expected return relatively similar, a very slightly lower expectation over the 20-year period at 8.5 relative to 8.6 for the current allocation. And it also would bring the standard deviation down to 11%, and leaving that, that probability of reaching your expected return relatively similar and well above 50%. One other thing that we looked at coming out of the conversation with the investment committee was, what if we were to not put 1% in high yield and were to put that into long-term government bonds instead? So you can see footnote number 2 down there. If we were to not shift that 1% that we took out of equity and put it into long-term government bonds instead of high yield bonds, it would have an expected return of 7.16% over the 10 years, 8.54, so rounding to quite similar from what you're seeing above, and would have a lower standard deviation at 10.94%. Again, a relatively similar situation. So not big differences in these numbers here. And if you look at the next slide now on 38, we've also added some additional analysis coming out of the investment committee discussion. One of the topics at the investment committee was, what if we were to reweight our public equity allocation into the weights of the MSCI All Country World Index? So a lot of people consider the geographic weightings of the All Country World Index to sort of be the broad global opportunity set, not taking a view on any particular region or developed versus emerging in terms of what's going to do better in the future. So if we were to reweight the public equity allocation, you can see in the box in the middle column, you would have less in emerging markets equity, the same in developed non-US equity, and more in US equity. So essentially, weighting like the MSCI ACWI index would just shift from emerging markets to US equity. Another analysis that we worked with and collaborated with your investment staff on, which is a bit confusing, is in the right column. So another thing that came up, which I thought was a great question at the investment committee, was, okay, we are underweight to the US relative to the MSCI All Country World Index in public equity, but what happens if we also include private equity in that calculation and private markets? It's a little bit harder to weight and determine, but Christina on your staff was able to do a calculation, and your private markets exposure is more weighted to the US than the non-US, than the ACWI. And so if we were to try to look at all of your exposure as a whole across public equity and private markets and try to get the full portfolio geographically aligned with the MSCI weights, that would include still reducing emerging markets equity, but maybe not quite as much, actually increasing developed markets equity because your private markets portfolio has less developed markets non-US exposure than the ACWI index, and then increasing US equity a bit. So at the bottom here, you can see how these changes would shake out in terms of expected return. Your standard deviation would stay essentially the same. If you were to lower emerging markets and increase US, you would expect a very slightly lower return, but also very slightly lower risk for the overall portfolio. Then we have a variety of other analysis that I know that you're used to seeing, because we want to start with these expectations, but also look at other types of analysis that don't include what Makita's models put out. And so therefore, I would highlight the scenario analysis, which is on pages 41 and 42. On 41, you can see that as you would expect, having more fixed income in your portfolio would generally be protective in market correction type environments. You do see not much of a change in post-COVID because that was a rate hike environment where you might want less fixed income. But if we look at the next slide on 42, you can see the positive scenario analysis as well. When I first started working at Makita 16 years ago, we only showed the negative because we want people to be able to sleep at night in selecting their asset allocation. But then many of us said, well, if we only showed the downside, then nobody's going to have the full picture when selecting an asset allocation. So looking here as well at the upside, when we have a recovery from a major market correction, as one would expect, more fixed income in the portfolio is not going to necessarily keep up to the same extent as a portfolio that has more equity. We also have stress testing on the next couple of slides, and then I'll highlight on page 47, we put together some economic regime management analysis. We found that the absolute level of interest rates and inflation doesn't matter quite as much as surprises in those factors. So here you can see, again, what we would expect. Your current allocation is more exposed to growth, which means in up markets, it should perform better than the Fed more fixed income scenario, but it's also more exposed to systemic risk, global financial crisis like risk on the right-hand side there. So maybe we can go back to 37. As I mentioned, we're happy to answer any questions you might have on our expectations or our model, and Zach is on the line. But I think I would agree that the default year to year, since we are looking at this annually, is to stick with an asset allocation that is working. But of course, we want to be sensitive to shifts in the market environment as well. Since the expectations for fixed income returns had gone higher, we're showing that allocation as well. And then the current portfolio is heavier in emerging markets than US, so we wanted to show that analysis additionally. So I'm happy to take any questions.
Thank you very much. Mr. Polani, is there anything you'd like to add or indeed detract from that analysis?
I would just say, look, I think we're in a very volatile environment right now. And I think since we had the IC, the market dropped quite a bit.
Mm-hmm.
It has recovered in the past couple of days. In general, if you look at the macro environment, my 2 cents is that, look, I think we still have, I think there was a labor report this morning. We still have a sound economy that's slightly slowing, right? Which is what the Fed wanted, right? So I don't think there's any big shift. The problem has been the rhetoric from the administration, which has caused a lot of volatility. And the jury is out on whether tariffs are good or bad. I think people accept that tariffs are a tax. But the problem has been more in terms of, is it going to be 25%? Is it going to be 10%? Is it going to be 250%? So I believe the Commerce Department has been asked to review and come up with a comprehensive tariff policy. And who knows, tariffs may actually, at some level, level set the playing field, and in the long run may bring back manufacturing jobs to the US. This is all a very roundabout way of saying that it's premature to write off the US. I also think that we shouldn't be taking action based on this. We shouldn't be taking action in a very volatile environment. We should probably wait for the next 3 to 4 months to see if there's any pattern and if any policy emerges. So that would be sort of my overall recommendation.
Okay, are there any questions or comments from trustees?
Yeah, I would just ask, what do you think in 3 or 4 months if it turns out that we're looking at a weaker market?
Debbie, can you speak into the mic a little better?
Yeah, I was just going to ask, if you saw some changes in 3 to 4 months that looked like the economy was significantly weaker. I know the Fed is concerned, is pleased by the somewhat slowdown in employment, but that inflation could be rising again, and so they're between 2 points. So if you saw that there was a start of a major correction, would you think that we should do something else?
Yeah. Well, firstly, I would say the market is not the economy, right?
Right.
So there is a disconnect between the economy and the market. So that's something to keep in mind. And if we do see a correction, so let me talk about the market correction first. If we see a correction, more than a correction, if we see a bear market, a correction is not enough in my mind. If we see a bear market, if there's a 20% drop in the S&P, we have some internal guidelines that say that we should call an IC meeting, right? And we should assess the market conditions at that point. And now this happened before, right? In March 2020, between meetings, we had a 35% drop. Now, granted, that was a very unusual event. Usually bear markets are drawn out longer.
Yeah.
In 12 days, we had a bear market in
Right.
March 2020. But if we had a bear market and the board, staff, consultants, and board can make an assessment, to the best of our ability, of course, is it going to go down further? Is it like previous bear markets? We will do a deep dive and analysis. And I would say if there is a significant drawdown, my priors, all else being equal, would be to add risk, to take on more risk and add to growth assets, because we rarely get those opportunities, right? Now, if there's a significant weakening in the economy, the other part of your question,
Right.
but the market holds firm, right? Then we should think about maybe taking some risk off the table. But those are discussions we can have when you're confronted with those environments. So I think the board should be focused not, I know we give a lot of options when we talk about moving things around, etc. But I think the right thing to do is to look at our level of risk, right? And so we have, through the various risk study and the board's decision, we have a 13% risk limit, right? And we are at 11.5. Is that the right? Should we continue at that right risk level? Is that the right risk level for us? Should we increase or decrease it? So that's really the question. And if I were a trustee, I'm not. I would say it's not the right time to change that risk level.
Mr. Chair? Yeah.
Mr. Linder?
Since the investment committee also looked at this, any
Mhm.
thoughts from the investment committee?
I have some thoughts I'll share, but I'll let other members of the committee speak if they wish.
Thank you.
Vice Chair Chandra, are you with us?
Yeah, no, I'm here. I'm happy to go last.
Okay.
In the meantime.
Okay.
Just don't rush to last here.
Okay.
I'll jump in. I'll jump in to give
Okay.
very simple comments.
A brave trustee Faulkner will move
and
into the breach.
I think as you ponder, as I'm pondering this idea, is I need to find a story, a thesis point, something of why make a change when we're thinking about the 30 to 50-year horizon. At any given time, we all wish, even in my own portfolio, that I sold the S&P 500 in January and bought, large cap China and large cap, Europe, and I'd be crushing it. I think that those decisions are hard to do. So I haven't heard, between the committee meeting, I think there was great discussions. I think it's worthwhile discussions, but I don't think there's been a structural shift in we need to change this because of the 30, 40, 50-year outlook of the portfolio. As you can tell, at a bare minimum, the changes that are being made are considered or leaving us in a very similar position that we are in right now. So I guess the tinkering, as much as I would love to do that, and I do that in my own portfolio against my better judgment as a finance faculty, I don't see much need for a change in the existing strategic asset allocation.
Thank you.
Thank you, Matthew.
Spencer, I'm happy if you want to. I've organized my thoughts. Thank you, Matthew.
Okay. Perhaps it'll be a case of point to counterpoint if I can advance my thesis first, and then you can jump in, Vice Chair Chandra.
Good.
First of all, I agree that, clearly this is a long-term investment, long-term portfolio, so a lot of the latest news on tariffs, this and discount rate that, should not affect our thinking much. And I do appreciate the CIO's interest and willingness to increase our risk exposure in the case of a bear market. I certainly believe that all things equal, that would be an appropriate move. I think we face two issues in the current strategic asset allocation. And one, of course, is whether or not we would incrementally increase our exposure to fixed income. And the second issue, as highlighted by Makita, is the equity exposure geographically. Addressing the first issue first, which is the top-level issue, the CMAs have come out, and what we are seeing in the numbers here is that if we increase incrementally our exposure to fixed income, the CMAs have almost identical expected returns over the 10 and 20-year horizons, and yet our risk level would go down incrementally. So if we have an opportunity to earn the same with less risk, that seems like something we should consider. And that just flows from the simple and obvious explanation that fixed income yields are up and equity valuations are high. So this could be an opportunity to shift ever so slightly to a slightly less risk exposure. That seems to me a reasonable thing to consider. If we move to, I forget which slide it is, the one, I think it's either the previous or the next slide. 38. Yeah. At this point, our current allocation shows we are double the allocation in emerging markets as the markets are as a whole. So whether by default or by just by inaction, we have drifted into a position where we are overcommitted to emerging markets, and I think it's worthy of a discussion if that is what we want to be. I know at the IC, and again here today, our CIO made a rather impassioned description of the U.S. economy and the U.S. markets being rather exceptional. There may be reasons to doubt that in future, and whether or not we want to necessarily increase the U.S. market exposure maybe is something to discuss. But our overexposure to emerging markets does seem to be an outlier, and the question is, do we wish to be an outlier in that regard? So those are the two things that that weigh on my mind.
Thank you.
Can I jump in now?
I think this is a good time.
Thanks for giving me the time. Sorry. Clear my throat. I wanted to make sure that I began my comments in the right place, and for me, this all begins with risk. We are an underfunded plan, and we're being asked, I joined the board, and I'm the longest serving member on this board when we were an underfunded plan. Fortunately, we are less underfunded now. And what we really focused on was what was the maximum risk we felt the portfolio could bear without, for lack of a better way of saying it, doing injury to the portfolio, making it hard to make payments to our beneficiaries. And so that risk analysis with Veris resulted in this 13% number. And so I anchor on that, and I notice that all of these options are roughly in the same area, a sort of a risk tolerance with which I'm comfortable. I guess my comment on, and Matthew's word was tinkering, is, for instance, I think last year a suggestion had been made to go higher into IG and kind of change our fixed income portfolio. And I believe we would be down year over year and also have paid the transaction cost if the board had taken that option. And that's where I struggle. Developed markets, emerging markets and equities, I can make a pretty bearish case, and I'm probably a little bit more of a bear in at least some of the way those indexes are created and some of the countries and some of the stocks that are in there. But I've also experienced over a 30-year career, 7-8 year period lag in a certain asset class, and all of a sudden it explodes, and then it's 10-year trailing ends up looking fairly decent. So my proclivity is to really change the asset allocation 3 to 5 years, unless there's something really structural that is taking place. I think we're going to be flying into some headwinds, but the fortunate thing is, we're not trying to land the plane anytime soon. We do have a really long-term horizon. But I want to end where I started. I really think we should be focused on risk, and we should be focused on not trying to make 1 to 2 to 5 year determinations. We tend to get some of those right, we tend to get some of those wrong. I don't think it ends up having much long-term value in the portfolio, and the engenders transaction costs and staff time. So I don't have specific guidance for these. My preference is to stay put and philosophically have that sort of be the culture of the way the board thinks about asset allocation. But I'm heartened by the fact that all of these options are maintaining a standard deviation in the 11.5 range.
Can we go back to slide 37, I believe? So just to be clear, this is the slide showing the two options that have been proposed.
Yeah, 11.5 and 11, correct. Yeah, my bias would be toward 11.5 or 12. I want to leave a little headroom because volatility being what it is, we could accidentally end up at 13 and start to bump up against our benchmark, or sorry, our policy mark. But 11's not that different than 11.5, but I do have a preference for 11.5 or 12.
Mr. Polani, it looks like you're eager to say something.
Yeah. Well, just the one comment. So you did mention there's two options here. There's more fixed income and that we have the same return at slightly lower risk.
Mm-hmm.
So I would just caution that the interpretation of those numbers a little bit. I'm not saying that those are not the numbers that they are on the screen. And you made 2 points. One is that fixed income yields are higher and that equity valuations are high, and therefore this makes sense. And since we ran the analysis, equity valuations are cheaper. So that's one thing to keep in mind. And fixed income yields have also come down. The 10 years come down quite swiftly, actually, by almost 40, 50 basis points. So it's still high, but it's come down and it can move very quickly. And the third point I'd make is that these numbers are not very precise, these expected return and standard deviation numbers, and there's lots of assumptions behind these models. So 5 or 10 basis points or 20 basis points, usually it's all within the standard error that we should expect. Just want to add those comments.
Okay. Any other comments from trustees or observations?
I do have one more question, and that is, if we found ourselves in a bear market and we thought it was a buying opportunity, what asset class would we typically try to reduce so that we would have the funds to make that purchase?
That's
Yeah.
a good question.
Yeah.
Trustee
Sorry.
When CIO Kalani made that comment, I thought to myself, that was a great move after we did the risk work with Veris, and we're planning to do it anyway in 2020, and got given this gift, although COVID was such a horrid tragedy, in being able to buy in the lower basis of the market because of that 2-week precipitous drop. But I don't know how much, we shouldn't have that conversation now because this is hypothetical, but I don't know where that would come from if we wanted to stay properly diversified as a long-term plan. We may have, at least in the thinking of some trustees like me, maxed out the last time we had an opportunity to do that.
Yeah. Are we maxed out, right? So that's a great question, right? It does appear, given that there's 75% exposure to growth assets, it may seem like we are maxed out. Like, can we go to 80? We can. In fact, we were at 80 at one point for growth assets. So there is room there. And it's hard for me to speculate now and say what the source is going to be. We certainly have 8% in low beta assets, 5% in cash equivalents, 3% in hedge funds, and those hedge funds are supposed to be market neutral. But if we want to take a directional bet in the market and we want to invest in growth, that 3% could be a source. We have IG bonds, we have long-term government bonds, we have TIPS, we have a bunch of options there to increase growth from, say, 75 to 80. But if there is a steep drop, and in the GFC 2008 2009, the market dropped 45%, and the dot-com bust, the market dropped 50%. And in those types of situations, I would say we go all in.
Yeah.
And, you know, I would take growth up to 85%. Now, keeping in mind, and I'm just giving some numbers here to make the point that trying to be accurate. Keeping in mind that the backstop for us is that 13% number, right? We've never got very clear guidance from the city on what that number should be, even though we've tried to get that in past surveys. But the board and consultants have all worked together and said, if we had a 13% standard deviation or a 12% standard deviation, what would the drawdown be in a 1 standard deviation event, in a 2 standard deviation event? How much pain can the city take? And that's how we've come up with that 13% number. So I would increase risk if there's an opportunity to buy growth assets on the cheap. I would increase it to 13%.
Thank you.
And if we were to adopt the Fed more FI allocation, would that not give us more assets to deploy in the case of a sharp drop down?
Yeah, I mean, we are talking 2% here, right? I think we have the source right now, but yes, you're right. I mean, if we adopted the more fixed income, that would give us another 2 to 2.5%.
Yeah, but we also have the opportunity cost of any returns you might have been, you give up if growth was doing it. It's not that simple a calculation.
Clearly. And Mr. Polani, if you would also address the other issue, which is our current, I realize the numbers, there's many ways to measure the index. If we can go to the next slide, by the way, slide 38. Having twice as much exposure to emerging markets as the universe.
Yeah, and yes, I did make a note of it, but I didn't address it, so my apologies. So that was not, so we did not drift to a higher EM. And I wish we had, because then that would have meant that we made a call to overweight EM and it did very well, and so it's become even larger.
So our genius was not at play.
That was not the case. But the board made a decision several years ago to actually take twice the weight. I don't know if it was consciously twice the weight. I have to go back and look at my notes. But the board did make a decision that we want a significant overweight in EM. This is going back to the point that we are an underfunded plan. And being an underfunded plan, where can we get the most returns? And I think despite everything that's happened, I believe Makita's CMAs still show among equity asset classes, EM with the highest expected return. And I'm sure Laura can pull that up. So that was a conscious strategic decision that the board made. And we've stuck to that. And in fact, I know this is too short a time frame, but that in hindsight, if you look at shorter time frames, like 1, 2, or 3 years, that bet has not paid off, right? Because the US has outperformed emerging markets. But that doesn't mean that's how it's going to be going forward.
Yeah.
In the last year to date, actually, developed market, non-US, has done phenomenally well. And now with what Germany is trying to do, I think it's going to continue to do well. And EM has also done well. And both those markets have actually outperformed the US. So they've been sort of a cushion for us in terms of being well diversified on the equity side. So Laura, I don't know if you have the numbers for EM.
Yes, they're on in the presentation on page 25. So, yeah, emerging markets have looked much cheaper than the U.S. For some time now, but they've mostly remained cheap until 2025 year to date, where emerging and developed non-U.S. have really been dominating relative to the United States. But you can see here that our long-run expected return for emerging markets is higher than that of the United States, and it used to be a bit more of a gap historically in our expectations with emerging markets. We made an adjustment to our models to de-emphasize the impact of potential currency forward-looking expectations, just because over many years the currency models have been so volatile that we wanted to really remove that element from the emerging markets return. So emerging markets equity is still expected to have a higher return going forward, in large part due to much lower valuations than the United States. Also, I think putting things in context, when we were in a period of really low interest rates, our expectations for asset classes across the board were quite low, in large part because interest rates are a big driver of expected returns. And so there were only a few asset classes that really were expected to have outsized returns, like private natural resources, emerging markets equity. So a lot of plans at the time, several years ago, really overweighted those asset classes to try to get to expected returns. I think one thing that we've talked about with your investment team is, if you were to lower emerging markets equity, is now the time to do so? Would you want to average into making that change over time, just given that emerging markets have been sort of not performing well the past several years, but are now in the current market environment, and it's very difficult to time markets and make a change geographically?
I would just add one thing, that with EM, the trick is really implementation. I think one of the trustees, maybe Trustee Chandra, mentioned the index construction. I think some of the index construction is quite poor. And so we are actually at the next IC in April, we're going to do a deep dive on public equity. And I think it'll be a very worthwhile discussion to have as to how we've implemented EM and to get the IC's feedback in terms of how we've constructed the portfolio versus the index. And I believe our implementation is sound and is designed to maximize return, because there are large parts of the EM index that are not expected to do well. And there are parts of the EM index that are expected to do well. So that's just something to keep in mind.
That's a great point. And even though emerging markets returns as a whole have been pretty disappointing, over the last 5 years, your plan's emerging markets equity has outperformed the index by almost 2% per year. So implementation has been important. And I'd also mention, we were talking about how would we necessarily react if there are big changes in the market. Much of your portfolio is actively managed by managers that are really, all day, every day, looking at trading and macroeconomic forecasts. And so those active managers hopefully can protect assets as well in a down market environment.
Do they have a track record of doing that?
We'll talk about the performance report, but yes, your fund's active managers have had lower risk than their indexes and kept up on the upside as well, for the most part.
Okay. I think it would be important also to look at slide 34. And this has come up before, and I would feel neglectful if I didn't raise it again. And that is the fact that the Makita capital market expectations for emerging markets, as we can see in the lower left quadrant, have continually exceeded the actual performance. And I guess we're always hoping that this is the year they finally catch up, and this is the year our outsized bet on emerging markets will pay off. But it is something to bear in mind as we have this nearly double the exposure as the rest of the market does for emerging markets. I think it's something to bear in mind. All right. Is there any other public comment on this issue? No comment. Would anyone like to formulate a motion on any of these issues? Okay, so then by default, we maintain the existing strategic asset allocation, or do we need an affirmative vote for that?
I think we need affirmative votes, so I'll move to maintain the existing.
We were about to be advised by counsel.
He stole the words out of my mouth.
Did he? Okay. I'm sorry then, Vice Chair Chandra, would you like to formulate a proposal?
I did. Someone can second it.
Okay.
I'll second.
Okay, so that's a motion by Vice Chair Chandra, a second by Trustee Linder, to maintain the existing strategic asset allocation. We'll have the roll call vote. Vice Chair Chandra?
Aye.
Trustee Vasti?
Aye.
Trustee Abbott?
Aye.
Trustee Faulkner?
Aye.
Trustee Linder?
Aye.
And the chair votes aye. Thank you all for that fulsome discussion.
So do we, Mr. Chair, do we return on this if things get crazy out there?
Well, I think it would have to be
Sooner than
agendized.
later, yeah.
Um, But I think this is what CIO
That's what I'm
Palani has said,
hearing.
that at first step, if things get crazy, is a calling of the IC, and perhaps we would even jump directly to a board meeting if that was the case.
If the market drops 20% in the next 5 days, you can be
Yeah.
assured that I'd call for a special board meeting. I would at least request one.
And I'm trying to recall the events of March 2020. Did we have an IC meeting before the
Well, it
momentous
just so
special?
happened that we had several IC meetings, special IC meetings with 24-hour notice as the market kept dropping. And it
Mhm.
became very obvious at some point that assets were very cheap. And
Okay,
so
I
the
do-
timing of the board meeting worked out very well.
Okay, and we had a special board meeting.
Yeah.
I believe
I
it was a
just wanted
special.
confirmation on what I thought I heard, so
Yes,
thank you.
yeah, of course.
It can be a challenge to pull together special meetings at short notice and having quorum, so,
When it's on our portfolio, it's less of a challenge.
yes,
That's right.
it's on our minds. Okay. Where are we here? 9:30?
Spencer, when are you doing your 5-minute break, at 9:30 or 10?
I was gonna do 10 o'clock. Would you prefer I do it now?
No, I just need to get extra checkout time, so I'll do that at 10, that's fine. I'm fine. I just wanted to know when I had to run to the registration desk.
Okay. Right, and then at 10:30, we are having
Yeah,
time
that's
certain.
Time
Okay.
certain.
So we're up to item 4D, presentation of our Calendar 3 performance for private equity.
All right. I would have thought you'd had enough of investments for today, but we still have 3 or 4
But
more
no.
items.
No,
But
it's-
we will be efficient.
It's okay.
Dinesh?
We have Casey Boyer from Newburgh Berman online, so go ahead, Casey.
Great, thank you very much. As always, thank you for having me. Today, we will go through the Q3 2024 portfolio and performance update for your private equity portfolio. Turning to page 2, oh, sorry, let me share my screen. I got started too quickly. Okay, perfect. Q3, as a reminder, Q4 always takes a little bit more time, so we expect to have Q4 in kind of towards the end of April, early May. That's just due to year-end audits. But here on page 2 is a good update for just overall metrics of your portfolio. You'll notice, and this is a fairly new addition, 2 columns in the middle. We have an NB Series 1 and an NB Series 2. That's simply different legal tranches. However, the strategy and in types of investments that we are doing continue to be the same investments. Obviously working very closely with your team on what investments are included, the investment pace and how we're committing capital by vintage year. So everything's the same, it's just simply broken out into series or tranches. When you think about what happened over Q3, performance was up slightly overall in terms of valuation, not anything drastic, as you can see here at the bottom. The net multiple really didn't move too much. If you take it out 1 extra decimal, it basically moved from 1.85 in Q2 to 1.88 in Q3. Distributions at a net level, there was a $3 million distribution during Q3. So essentially distributions moved from 54 million to 57 million. I will say, the hot topic across private equity and kind of alternatives markets in general is the slower exit environment, slower realizations that we're seeing. However, in Q4, specifically within your portfolio, we saw some really good distributions, and for Q4, we actually distributed on a net basis a little over 12 million of capital. And in Q1 so far have distributed about 2.5 million of capital. So we did see quite an uptick within your portfolio in Q4, which was very nice, coming from some co-investments specifically. And then I would say when we're thinking about Q4, we don't really expect a ton of changes in valuations. I think I've come on here for the past 2 years and kind of spoken about valuations are really par across the market and distributions are low, and that message is still continuing. We're hopeful that 2025 will gain some ground. When we look at the IPO market, what has happened in 2025 so far, it's a little elevated in terms of companies that have IPO'd compared to 2024, but still very low compared to historical metrics. So we're watching that closely. Obviously, that's a big exit environment for private equity companies. And so that's kind of the general overview for Q3 and kind of what we're anticipating for Q4. I will turn to, and I'll stop on this page for a second, just given the discussion topic right before this, but you can see here specifically how Neuberger commits across geography, and we are very heavy in North America. It always has been a very strong private equity, very mature market with lots of companies and lots of options, and typically very good exit. So we always do go pretty heavy in North America. When we look overall at the performance, we have it separated here by primaries, secondaries, and co-investments. Again, not a lot of change between Q2 and Q3. And at the bottom here, you'll see how the portfolio is benchmarking and a little bit more detail on the performance between Q2 and Q3. And then, so this is Series 1. This is obviously a portfolio that is mature, that is fully committed, that is pretty fully invested, and already starting distributions. So that's kind of where we are with that portfolio. Series 2, we are actively committing out of. It's very new. And so you can see how that plays out in the primaries, secondaries, and co-investments. Secondaries and co-investments are a great way to kind of generate strong early returns. And that's exactly what you're seeing here in the portfolio. Primaries tend to have that J-curve effect where you're putting capital to work. Primary funds are going to put capital to work over a few years, and so we tend to see kind of that performance lag. But that's where the secondaries and co-investments come in to help with the overall portfolio returns. You'll see between Q2 and Q3 performance, the net TVPI did go down slightly. That is not because valuations or performance went down. It's simply because we're continuing to put capital to work, and all of those investments go in at cost. So it's really just a leveling of commitments and the continued effort of us putting capital to work. I'm going to take a pause there and just see if there's any questions or if there's any portfolio or market questions. I'm happy to go through.
Great, thank you. Are there any questions from trustees? Okay, I see none.
In which case, we can move on to, thank you, Casey. We
Thank
can
you.
move on to 2E. Sorry, I said 4E.
Well, hello again. I think I've got my computer figured out here if I can screen share again. I should know better than to try to log into my work Citrix from city Wi-Fi. Okay, great, thank you. Okay, let me full screen here. So here, I'll start with the private markets report for the city of San Jose Federated Retirement System. We have on page 1 here the overall program. You can see on the left each type of private markets asset class that you have invested in. The legacy private equity, Neuberger Berman, and then private debt, real estate, real assets, and venture capital programs. And then I direct your attention to the far right where you can see your pension fund's internal rate of return, or IRR, relative to a public markets equivalent, or PME. So the 2 right columns show that all of your private markets programs, with the exception of venture capital, which is quite immature, have outperformed their public markets equivalent. So if the same dollars had been contributed to a public markets index in the same asset class and withdrawn at the same time. So strong performance here for your program. The first program I'll delve into in more detail is the private debt program. This has been around since 2010. Currently, the allocation is 3.9% of your total assets relative to a 3% target. As you know, these percentages of total program shift around with the denominator of the plan changing, and when there are asset allocation changes, it does take some time to get to allocations in private markets given the committed and called capital structure. There were no new investments during the quarter, and you can see the individual investments in the program on pages 5 and 6. You know, I draw your attention to the fact that the first few investments back in 2010, which were originally not in a private debt asset class but were designed to be opportunistic, you know, have really dominated the program for some time. But now that we've, that your staff and Makita have worked together on this program over a longer period of time, you do see more vintage year diversification. And I'll mention, you know, many of the internal rate of return, the IRRs for more recent funds have been quite strong. You can see the diversification in graphic form on page 7. And I'll just mention on the upper left that you are seeing a lot more vintage year diversification than we've seen in the past as commitments are made year over year. And we did talk, I know, in the asset allocation discussion about how the majority of the private markets program is in North America and the United States, and you can see that on this page as well. The next program is the Real Assets Program. So as of the end of September, it stood at 2.5% of your total fund relative to a 3% policy target. And there was one new commitment during the quarter that we're evaluating here, Primary Wave 4. Looking at the individual funds on pages 11 and 12, you can again see the IRRs. There are 2 small co-investments that I know have been addressed by your staff historically that have negative returns. The good news is that they're quite low allocation amounts relative to your total program, and the total IRR of the full program is over 10%. This program is also well diversified by vintage year and geography. The next one is the real estate program, which stood at 3.8% of the total retirement system relative to a 3% policy target. There were no new commitments during the quarter in question, and you can see on pages 17 and 18 the individual funds in the program, and again, you know, strong performance from your funds relative to peers. Mostly North American exposure, also good diversification from vintage year. Lastly, the venture capital program is the most immature program. It stands at only 1% relative to a 4% policy target. There were no new commitments during this quarter, and you can see the individual funds here on page 22, most of which are not meaningful returns yet, all having been invested in the last 5 years, which is a relatively short time period for the venture capital space. Most funds were invested in 2021, and most are in North America. And then the last many pages, dozens of pages of this report are going into different areas of the private markets marketplace in terms of fundraising and different dynamics. So I will, in the interest of time, just take any questions on the private markets program as a whole.
Great, thank you. Are there questions from trustees?
I have one question.
Please.
And just remind me where our investments in real estate are, what types of investments they are?
They're pretty widely diversified. So you do have less exposure to office than some stronger areas, but I'll let Dinesh elaborate.
Thank you. We actually gave a detailed presentation to the investment committee in January, which had a breakdown for the two real estate portfolios that we have, which are the growth real estate and core real estate portfolios. So the growth real estate is the one that falls within private markets, and very low office exposure. So 10% of the portfolio is within the office. The vast majority are in better performing sectors. So 33% in industrial warehouses, 31% in multifamily apartments, and a significant exposure to other alternative sectors like self-storage. And recently we've also been investing in data centers. So our managers and the type of commitments that we've made over the last 5 years have actually performed well, avoiding some of those sectors that have been most affected by changes in demand drivers and also the impact of interest rates.
Thank you.
Any other questions from trustees? If not, let us proceed then to 4F.
Okay. Thank you. So next up is the total fund report. And I'll just sort of set the stage with the index performance on page 5. So taking a look at the full year of 2024 and the fourth quarter, you can see that negative returns for U.S. equities during the fourth quarter were not enough to really dampen the full year returns very much. 2024 as a whole was a great year in the markets. You can see that the only negative major asset class was emerging markets bonds there at the bottom. However, on the right side here, you can see more asset classes negative than positive during the fourth quarter. You know, one thing I just personally find interesting is that sort of the news media and the market sentiment seems to focus only on U.S. stocks when talking about whether or not the market is doing well. Obviously, institutional investors like yourselves have really diversified portfolios. So during the fourth quarter, I think the news media talked a lot about the stock market doing well. However, you can see that there were only a few asset classes, mainly U.S. equities, that did well. And then if we look at the year-to-date of 2025 through yesterday, we have U.S. equities down between 3% and 5%, depending on whether or not you're looking at large cap or small cap. We have commodities up 8.4%, emerging markets up 6.7%, non-U.S. developed market stocks up 11.2%, and then high-yield bonds, investment-grade bonds, TIPS all up 2 or 3 or 4%. So a diversified portfolio like yours, even though we see obviously a lot of really negative market headlines right now, we estimate is up about 1.5% for 2025 thus far. So diversification, if you look at 2024, probably wasn't our friend. We should have been 100% U.S. equities if we had a crystal ball and perfect hindsight. However, diversification really does seem to be working for your fund so far in 2025. A lot of other market slides here. I'll mention, you know, the Fed met yesterday, as you probably know. They left rates unchanged, are expecting about 0.5% still of cuts sometime in 2025. Usually they do that in quarter point moves, so that would indicate 2 moves. They did downgrade the economic growth forecast from 2.1 to 1.7% and slightly raise the inflation forecast from 2.5 to 2.8. So I think that's, you know, these are all dynamics that we're all observing ourselves in the markets in terms of volatility, but, you know, not major moves for long-term expectations overall. We have the executive summary on 22. I'll mention that during 2024, the plan had $240.2 million in investment gains. So just wanted to point that out as we go into just the specific fourth quarter update. You can see on page 30 the overall market value of the pension plan at $3.2 billion. And you can see returns on 31. As I mentioned, the fourth quarter of 2024 was negative in markets. You had a return of negative 1.4% for the fourth quarter. That did outperform your policy benchmark, your investable benchmark portfolio, and the low-cost passive portfolio. It was behind peers in the fourth quartile. You can see fiscal year to date, the return was 2.5%, so for the first half of the fiscal year, and for the 1 year was 8.1%, a bit behind the policy benchmark, but well ahead of the investable benchmark portfolio. If we look out over the long term, the 3 and 5 year returns were both above median, with the 5-year return, which, you know, we generally think of 5 to 7 years as a full market cycle, that 5-year return in the top quartile of the peer group and outperforming all of the benchmarks that you see listed. For the 1 year period, you know, you can see that the returns were really driven by U.S. equity. U.S. equity up 23.5% and slightly ahead of its benchmark. We saw slightly positive returns for international. You know, 5.6 is quite strong normally, but not a 23.5 like the U.S. And then, as I mentioned, emerging markets has been outperforming its benchmark. You know, protecting on the downside in the fourth quarter. You can see outperforming the benchmark for the 5-year period by nearly 2% per year. Private markets has also been a very strong area long term. You see an 11.4% average annual return for the last 5 years. All of your managers are performing as we would expect, and we are in regular collaboration with your investment staff. On the managers, we do have a watch list in the executive summary. As you know, any manager that underperforms its benchmark for 3 or 5 years goes on that watch list and receives more intensive monitoring and call outs in your report. But I would also just want to end my comments to talk about risk as well, since we've focused mainly on asset allocation and return so far. On page 59, so let me go ahead here. On page 59, we have my share going away. Let's see. The risk-adjusted returns. I don't know what's happening here. Sorry about that. If we, let's see here. Take a look. It seems to have just shut down again on me. So I'll just mention, let me stop sharing and maybe your helpful staff can put up page 59. But we do look at a variety of charts, the annualized return, the annualized standard deviation or volatility, and then how that shakes out in terms of risk-adjusted returns, because we want to look at not just as absolute levels of risk and return, but how much return are you getting per unit of risk that you're taking on in your plan over the long term. So I just highlight page 59, the 5-year, or, you know, as close to a full market cycle as we take a look at typically the Sharpe ratio, or measure of risk-adjusted return, and the third column here is well in the top quartile. Your return has been above median, your risk has been below median, leading to strong risk-adjusted returns. So I'll end my comments there and happy to take any questions.
Great, thank you. Any questions or comments from trustees?
I have a question.
Please.
On page 20, this is actually an academic question. On page 22, the system's net of fees performance for the quarter was minus 1.4, and the peer median return was minus 0.9%. Now, if median is a 50th percentile and our performance is lower, I'm wondering, how do we rank in the 80th percentile of the peer group?
Sure. So we have some more information on peer returns and allocation. Maybe I direct your attention to page 62. So the information we have on peer asset allocation isn't perfect. It's sort of self-reported. So while one fund like yours might break out non-US equity and emerging markets equity, another fund might just report global equity as a whole. So you can see that the population of the peer group is 108 plans reporting, but only 44 of them, report how much global equity they have. Only 35 of them report how much developed ex-US equity, but it's sort of the best we have in terms of this peer group as a whole. So of these public defined benefit plans greater than $1 billion, your plan's US equity was in the 69th percentile. So I think that's a big driver. You know, as I mentioned, for the fourth quarter in particular, US equity was really the only positive asset class. So for that short 3-month time period, that I think was really driving the peer relative returns.
So that's just for the US equity, but then on your summary page, that's for the entire performance, right?
Yes, yes. So the asset allocation is going to feed into the overall returns. And so if your plan has less US equity than peers, US equity is the only thing that did well, then I'd expect your plan's return to be lower than peers.
So when it comes to the peers, is it just the US equity that you are tracking against, or is it, are there other asset?
It's the full funds, but given that all asset classes were negative for the fourth quarter except for US equity, that was the big driver of the difference.
Okay, I still don't understand how are we 80th percentile when our return is lower than the median
Well, 80th,
percentile of the peer group.
yeah, as you know, 80th is the bottom, right? It's not the
Okay,
top.
so the fifth, okay, I
Yeah.
think, okay.
Yeah.
I think we can chat offline.
So we are in fact in the very top emerging market equity exposure of all 59 plans in the population here.
Of the half of the population that reports emerging markets equity, yes, your allocation is quite high.
Okay. So I would reiterate that point. Any other questions from trustees? Great, thank you. We can proceed. See, we almost are approaching the 10 o'clock hour. Let us take a 5-minute break, if we will, before we close out investments with item 4G. Thank you.
Recording in progress.
resume our agenda. I believe we're up to item 4G, which is the performance of the Healthcare Trust.
Thank you. I'll skip right to page 28 to look at the overall asset allocation of the Healthcare Trust. Current assets as of the end of December were $425 million. And you can see the allocations quite close to targets. Taking a look at the return here, as we've discussed many times in the past, this healthcare trust is a bit riskier than the other funds in the peer group, which has been quite positive in a generally long-term market that's positive for equities. And so you see 3, 5, and 10-year returns and 1 year as well since inception, all above median. However, you do in down equity markets have more negative returns than the peer group for this fund. And so you can see the 3-month, 1-quarter return at negative 2.4%, slightly behind the policy benchmark. If we look at the longer term time periods, 1, 3, 5 years as well, you do see much stronger returns, especially in the context of the peer group. You can see here that the 1-year return for U.S. equity was almost 24%, international at about 3%, and emerging at 7.1%. Come on, computer. Sorry for all my technical difficulties here today. Taking a look at the individual managers, as you know, this fund uses a subset of the same managers that are in the pension fund. So you have a few of the active managers, mostly passive index funds, however, and this fund has no illiquid investments. If we take a look at the same risk statistics that we talked about on the pension fund, you can see here over the trailing 5 years a very strong Sharpe ratio or risk-adjusted return in the third column. I'm happy to take any questions on the Healthcare Trust.
Thank you. Are there any questions about the Healthcare Trust from trustees? Okay. Is there any public comment on this entire section of investment performance? Seeing none, thank you. And we will move on to section 6
Thank you very much.
of the agenda. And that is section 6A, oral update from our CEO, Mr. Flynn.
Good morning, trustees. I'm delighted to announce that our senior office specialist position has been filled by Cecil Abiog. Cess started in our healthcare team as a temp in March. We're delighted to have her join the ORS team in her new permanent position. She brings with her an extensive data analytic background, having previously worked for Cisco, VACO, San Francisco, and Hive Solutions. For our accountant position, we're in the final stages of recruitment. Interviews were conducted, and we expect to have the position filled in April. I've completed a 6-month check-in with our senior managers on the administrative side of ORS. Generally, feedback has been good for me, and some good reminders of some areas that still require some focus and that staff would like me to continue to provide attention to. Tier 1 Federated Handbook, it's about a 100-page document with all the Tier 1 rules and details, has been published. It's a Herculean effort to put this type of document together with all the rules and regulations. A special thank you to Donna Bussey and Melanie Kermsey and the rest of the staff involved and the hard work on this project. We published a 4-page 415B fact sheet to help our members and staff understand this complex topic. Thank you to Sandra for pushing this project over the finish line. The mayor's March budget message was approved on Tuesday after almost 4 hours of public comment. Which means that we ORS are knee-deep in the budget season right now and hope to present a budget to the boards in April for discussion and approval. 3 budget requests that we have submitted to the city on the personnel budgeting, as part of the personnel budgeting process, was an add and delete for a senior investment officer position to be replaced by a deputy director of investments or a deputy CIO. We've requested to add an administrative officer to focus, to have centralized focus on compliance, administration, and policy, and a deletion of our senior auditor position, which doesn't mean the function is going away, but it does mean that we would look to outsource the internal auditor function to a consultant. So net, no increase in overall headcount, but definitely some changes within the heads themselves. Staff and I have been working with Jim Shannon and the CMO budget director, answering questions and emails, and I had a meeting with Jim yesterday to review their current assessment of our requests and some driving into a little bit more detail in some areas so that there was a better understanding of ORS's needs and wants as part of these requests, so that the CMO's budget office can make recommendations, or can work with the mayor's office to make recommendations, not just on our budget, but all of the appointee budgets. I'm looking to schedule some time with the mayor's office budget as soon as they're ready to meet with me. ORS lease expires at the end of this month, which, you know, is not it's pretty close. We cutting it close here, but working with Barbara and Benji and some of the city real estate resources, I think we've been able to put together a good lease, and we're going to go through that in a discussion and action later today. So I don't want to go into too much detail. We have done a tremendous amount of procurement work over the past, well, couple of months, but this past month has been extremely heavy. As you know, we're procuring legal services with 6 different legal services types. All of them have required proposals and scoring and interviews, either interviews with staff or interviews with staff in the JAHC. We'll go through all the details of that later on. But what I would like to focus on is, we'll let the governance committee talk about that for the governance services during the committee overview. As I've mentioned before, just as a reminder, we're targeting September as for board retreat. So just as part of your calendar, please make sure that you're reserving a long day for the September board meeting. For our Federated members who are preparing to retire, we have a quarterly retirement workshop that we hold via Zoom. Members can register on our website. And just as a reminder, the next Federated quarterly is May 8th from 8:30 to 10:30 a.m. It's a good session where you can get some general information and then have some specific conversations as needed. We are in the process of both implementing a mobile device management solution as well as going through a replenishment process for our trustee iPads. So in the very near future, we'll be coordinating with trustees to either enroll their iPad in the mobile device management solution and or replace older iPads. So newer trustees may have a newer iPad that doesn't require being replaced, but it may need to be enrolled in this mobile device management. So some are already enrolled, but the ones that are not will be. Myself, Barbara, and Bill Hallmark are tentatively scheduled to present our valuation reports that these boards, that our boards have previously approved to City Council on April 8th. Our Retirement Connection newsletter is scheduled to be distributed in April to members and retirees. Just as a reminder for the retirees and membership that this will be the last newsletter that will be defaulted to paper. For the summer edition, we will default to digital, but of course we will allow our members to opt into a paper distribution if they choose. And details on that will be included in was included in the last quarter newsletter, will be included in this quarter's newsletter. Reminder to our members that Fed retiree COLAs will be paid this April, and that our offices will be closed on Monday, March 31st in honor of Cesar Chavez Day. With that, I will take trustee questions.
Thank you. Are there any questions from trustees? I wonder if you could say a few more words about the budget process and our request to do an add delete to reposition our internal auditor as an administrative officer to enhance our compliance, and our add delete to modify our senior investment officer to be a deputy investment officer.
Sure.
Have we received positive feedback from the city finance department on those requests?
So what I'll say is our submission for the requests, I think we're done in, I don't know if it's late January, early February. Working with the budget office, we've had, I don't know, this is my first time through the budget process, so I don't know if it's a large number of questions, but we had what I would consider to be a large number of questions for them to better understand what we're trying to accomplish with these changes. I had a follow-up discussion with the budget director, Jim Shannon, yesterday. It was a very good collaborative discussion. There were concerns about all of the requests. You know, I think the budget office works with the Human Resources Office to make sure that our requests fit from a city's classification standpoint, as well as that there is a well-documented need for the resource. So trying to help someone who is outside of ORS to understand the needs that we're facing, and then helping me understand some of the city classification dynamics. So there was pushback on the administrative officer as not I don't think it was from a need standpoint, but it was from a classification standpoint. They were concerned that that position was too high level inside of the city's classification, and they suggested something lower. After the discussion, I think there was a suggestion that maybe not as high as that we would want as administrative officer, but maybe something a little bit lower could meet all the needs that we were describing, but higher than what their suggestion was. For the senior investment officer to deputy director of investments, there was concern about that there's a small classification issue. The senior investment officer classification says it reports to the CIO. In this new structure, that potentially would not be the case. A senior IO could be reporting to the deputy CIO or the deputy director of investments. And so there was a small concern over that, but I think the bigger concern was some salary compression and whether or not it was the right organizational structure long-term.
Well, I hope as the discussions continue with the city, they can take a holistic approach and understand that our investment staff perform a very critical function and has a direct impact on the types of returns we've been able to achieve. I know in my 5 years as a trustee, they've done a very admirable job, and I think it is very prudent that we have a deputy director to manage that large department. I bear in mind the mayor's recent interest in performance-based metrics for senior staff, and on that score, our investment team has, again, done admirable work, and I think that I would hope that the city would recognize that and allow us to organize our investment staff as our CIO and as the boards and trustees deem appropriate to achieve the returns that we so rely upon to meet the needs of the members and to minimize the burden on the city budget. Any further comment or questions from trustees?
No, I think, Mr. Chair, I think an administrative officer is warranted, given knowing what an administrative officer does.
Right.
Department, ORS needs an administrative officer.
I would agree, certainly given the recent history of the plans and questions that were raised about operations within ORS. This would help us to meet our goals and our commitments under the MOU with the city to have a tighter administration of the system. So any assistance you may need from the chair or from the board, please reach out and I will provide that.
I would say we're still early in the process. Again, I'm trying to establish a meeting with I'm learning the process and want to make sure that I'm not jumping over any of the appropriate steps. And so I've just this morning reached out to the mayor's budget office to schedule the next stage of the discussion. I should have I think, better feedback at that point, and in which case I'll be happy to discuss.
Okay, great. Any other comments from trustees? Any public comment on this item? Seeing none, we will move forward to item 6B, which is an oral update from our city council liaison.
Thank
Vice
you.
Mayor.
Thank you. This, that leads me into my major topic, which is the budget. We did pass the mayor's March message, which is appropriate because it's March. We have to go forward. The message is really, it forms the budget going forward, and we did approve it. There are two what I would call controversial areas, but I'll point out that the budget, we did have a $45.7 million deficit, which is better than what was projected in December, which is a good thing, but we're still at a deficit, and that the deficit is projected to be much higher than that next year, 26-27 fiscal year. So we're doing things in the budget today to looking at a budget in not just a one-year cycle, but a two-year cycle, because we have 2 years to be concerned with. One priority from my perspective and from the city's perspective, we did freeze hiring. That occurred in December of the majority of departments. However, it did not freeze certain key departments like police and fire. There are others, but those are the main two that there is not a hiring freeze on. The goal is to avoid layoffs and to retain our staff as it is. There may be some realignment of staff or reorganization of staff, moving them to different positions, as the city manager then takes the mayor's message, which was adopted. City manager now creates an operating budget, and in the operating budget, there may be things that are reduced in scope. So staffing is, we retain the staff, but potentially move them to other places. Too early to say what that is yet. The city manager's budget won't come out until May, followed by a series of study sessions, public study sessions, where both the public and the city council will be able to offer input, ask questions on the various areas within the city of San Jose that are all part of the budget. Then the budget will be formally adopted in June, but along the way, there will also be town hall meetings in each council district, and so there's going to be at least 10. There will probably be as many as is needed beyond that. The mayor likes to go out and talk to people about the budget, so if you have any groups that want to hear about the budget process, I'm sure he would be willing to come out as his time allowed, and as his vice mayor, I can help in that regard, although he's so much more articulate on his budget than I am. The budget does focus on the priority areas that have been both my priorities, his priorities, and frankly, council's priorities for as long as I've been here. Public safety, addressing the unhoused, blight, and economic development. All those things go together to improving our city. But I just want to emphasize the importance of retaining our staff, because without the staff, the work doesn't get done, and our residents aren't satisfied in the work that we're doing because everything gets delayed or postponed or not happening at all. So I have a commitment to staff. I also want to thank I notice there's a lot of retirees this time around. I understand that happens in March. I'm used to seeing it on police and fire side, and that tends to happen in January. So now I see it happens in March, and I understand why that happens in March. I see a lot of names of people I know that I have worked closely with, and it's sad to see them all go, and I hate to think of it as retirement. I think of it as leaving this job and going to another chapter in their life. So I want to thank all of the retirees for the work that they've done and their commitment to the city of San Jose, and I wish them health and success in their future life. And finally, about your staffing question regarding ORS, the give and take, I am on the Budget Brown Act with the mayor, so when it comes up, I will mention it and we'll discuss it there too.
Great, thank you.
Thank you.
With that, that's pretty much top of mind.
Okay.
I have one question, Pam.
Sure.
My question is, when we talk about the $43 million, I think you said, what percent does that represent of the whole budget?
That's a good question. I don't have that answer. It's a $1 billion budget, so
Yeah.
someone do the math.
About
4%.
It's not a huge number,
about 4.5%.
but
I
it's
think.
enough that it's concerning, that it affects programs. And frankly, one of the issues, and I mention this every time we talk about the budget, is related to the retirement funds. It's related to the unfunded liabilities that resulted many years ago and continues to be drawn down and paid down, but that unfunded liability or drain on the general fund will not occur for a long time. If we didn't have that unfunded liability, which is a commitment, and I'm certainly, no one should think that I don't think it's something we should be paying, it's absolutely our commitment, we would have more fund in the general fund, and actually we'd have a balanced budget.
Understood.
So, but we're not, it's not where,
We are.
that's not where we are, right? And, you know, there's other things that are happening, and we don't depend a lot on federal government except for grants. There are a lot of areas that we get grants for, street
4.5%.
improvements, things like that, that we're concerned we're not going to get, public safety issues. So we're concerned about the state of the economy as well, and sales tax revenue is down, which is interesting considering how much people are buying on Amazon. But we get sales tax down, property taxes are down, transfer tax is down, which is where we get Measure E funds, and that helps supplement our budget as well. So
Can I just ask a question about property taxes? Why would they be down? Because it seems like property values are up, and new purchasers would be paying more.
I'm in some degree, but the property tax assessment, true, property taxes, property values or taxes are based on assessed value, not purchase price.
Right.
Unless people are purchasing in this year, and then there's a
Right.
delay in the supplemental property taxes. But when you're thinking of property sales, property sales have decreased,
Yes.
which means that fair market value on those properties are not being gained through property taxes. So it's not that the amount is decreasing, we're just not seeing an increase in property taxes. But hopefully the real estate market will pick up. It's not, but we'll see. And then that also influences the Measure E transfer tax, which is a tax on sales of properties over $2 million. So that's really the bucket we're looking at now, and was approved in the budget to help offset the cost of building 1,000 emergency interim housing units and manning them and providing programs and all that goes with our addressing our homeless population.
Thank you for that explanation.
Yeah.
Thank you. Any other questions from trustees?
I did want to echo the Vice Mayor's comments. I see 3 people I spent a lot of time with on the retirement list, and I think the city will miss them. Carl Mitchell, Nancy Klein, and Kip Harkness. So,
Absolutely. Yeah.
But I appreciate you calling that out. These are all good people. And
Absolutely,
so,
every one of them. Thank you.
And they will all now begin collecting their pensions, for which
That's
we are
right.
responsible.
I started calculating some of them just to see where they went.
Okay. All right. Any other public comment or questions of the vice chair? I'm seeing none. Thank you so much. Hopefully, our work here is helping to create a little bit more space for the city budget. I believe we have turned the corner in terms of the growth of our impact on the city budget. So,
Thank you. You're doing the right thing.
You have a comment, public
oh, I'm
comment.
sorry, we do have a comment. Please go ahead, speaker. We have 2 minutes.
Thank you, Mr. Chair. This is Brad, and again, just want to extend my welcome to Vice Mayor Foley to the as a City Council representative to the Federated Retirement Board, and really appreciate her participation, and glad that maybe we're going to see a fresh new set of eyes in terms of the operations of the Federated Retirement Board, and also my previous comments earlier in the meeting, I neglected to point out many of the outside selected public members go to many of these conferences, and I believe Mr. Horowitz, you went to one previously earlier this month at a nice location, and now you're going to the Ritz-Carlton at the end of this month. So my question is, what added value is this adding to your management of the Federated Retirement Fund, seeing as how we're 60% funded, and the board just comes every month to these meetings, you know, nice and cheerful. In the meantime, the retirees, although they see their checks coming every month, which you pointed out, they have no idea of the health of the retirement fund. So I'd like those issues addressed, and I guess specifically, what added value do you get, and do the taxpayers and the retirees get when you go on these so-called educational conferences? Thank you, Mr. Chair.
Thank
and
you.
I'd like to speak on item 6.3 when that comes up.
Okay.
I don't think that included a question for me.
No, but I'll take a stab at answering it. I believe you were on the line when we earlier had a fairly detailed and fulsome discussion about the strategic asset allocation. And my questioning of staff and my questioning of the consultants is largely informed by the sorts of things we learn at these educational seminars.
Right.
So these are the sorts of questions and education that drive us to attain performance, which has raised the funded liability from, I believe, 53% when I joined 5 years ago to 61% today. And that may seem like very small percentages, but in the world of big numbers, that's a big move. So we have the educational conferences in part to thank for that. So I appreciate your question. Thank you. And that segues quite nicely to 10:30, which is our time certain item at 10:30, which is the interview and appointment of the vacant trustee position. Hopefully, the trustees have had a moment to review the applications of our 2 trustees. I'm very thankful that we have 2 very qualified applicants. I will take them in the order in which they appear on the agenda, which is Mr. Brian Chi first. If you want to step forward, I appreciate that.
Hello.
And first of all, I'm not sure I can use the word apology, but I do feel this is a very strange way to do a job interview in public in front of the cameras. So my feeling for you in that regard is extended. However, it's a requirement of the Brown Act that we do these things in public. So it's quite unusual. I appreciate that. That said, I'll give you a few moments if you'd like to introduce yourself and your interest in the board and your background, and then we'll ask the trustees to ask some questions, and then we'll proceed to feats of physical endurance.
Sounds good. Board, my name is Brian Chi. I am the Principal Investment Officer for the City of San Jose. In this role, I manage the city's treasury fund and any excess funds that we use for investment. Our treasury is governed by the state code. We can invest out to 5 years, only fixed income, only investment grade. I've been doing this role for roughly about a year. Prior to this, I was a portfolio manager and trader for BlackRock's iShares index funds. I managed fixed income funds for municipal bonds. I managed about $3 billion personally. we purchased municipal bonds into these portfolios for investors to, purchase into their own accounts. As part of this, it's my understanding the markets was very important. We have to cover all types of risk. As you may know, index funds generally are seek to achieve the market return. That may seem fairly simple, just buy everything that is in the market. It is not quite so simple when you're managing fixed income. You cannot just buy every single bond. So you have to figure out what types of risk you're covering, how to replicate that index using sampling, and sort of understand where your returns are coming from. Prior to that, I was a trader and investor for the firm Kane Anderson Rudnick, where I separately managed accounts for high net worth individuals and institutions. So I've been an investor for 11 years. And prior to that, I was an investment banker covering California municipalities for the firm De La Rosa and Company. And I graduated from the University of Pennsylvania.
Great, thank you. Well, I'm going to open it up for trustees to ask questions, and then we'll open it up also for public comment after the trustees have a chance. So any of the trustees would like to ask Mr. Chi about his qualifications, interests, and potential to be a colleague of ours on the Board of Trustees.
I have one question.
Please, Trustee Abbott.
My question is really what motivates you to be part of this board and to take time from your busy schedule already to devote time to the things that we would be considering here, which range from investments, but many, many other things as well.
Yeah, so as an employee of the city, I am a beneficiary of the trust fund here. And generally speaking, I appreciate the work that the board has done. I think, as Spencer alluded to, it's had a pretty good improvement over the past 5 years. That said, I think as a professional investor, I do think professionals generally understand a little bit more than lay people. And in that sense, I would like to be able to provide my perspective for the board. Additionally, I do think, as I mentioned, this is something that I will be benefiting from.
Okay, thank you. Any other trustees? Mr. Linder?
Yes, thank you for applying, Brian. I have an interesting one because I have a similar challenge with this. As a trustee, you will have the fiduciary duty of loyalty to the members of the plan and will not be representing the city, and in my case, the retirees. Is that something you are aware of? And with that, do you think you can exercise independent and unbiased judgment and not be influenced by interests outside of the board?
Yes, I think I can. As I've mentioned, I have been an institutional investor for 11 years. My duty has always had a fiduciary responsibility to our investors. There are things that can influence you, but it's your job as an investor to separate that. I think historically people have thought, advisors seek to benefit themselves, but over the past few years, there has been a push for people to actually focus on their fiduciary responsibility. I've never been a quote-unquote broker. I've always been a fiduciary.
Okay, thank you.
Thank you. Any other trustees?
Thank you, Brian. My question is, in the next few years, what do you think are the main issues that the board needs to deal with?
I think continuing to grow the fund will be something that the board should focus on. I do think understanding how we set our discount rate and maybe increasing it or decreasing it will definitely help with the, I guess, understanding and focusing on the growth of the fund. Setting the asset allocation, I think, is something that the board should focus on as well.
Okay.
Spencer, I was waiting till people
Oh.
were there in person. Is it okay if I jump in now? or
Sure.
other
You bet.
questions?
This
Go
would
for
be
it.
a great time, Vice Chair.
Thank you for your application, Brian. I just want to play off some of your remarks about having expertise in investments and having spent some time as a fiduciary managing portfolios for private capital as well as for the city in a cash management capacity. I have been serving on the board for 9 years, and I've served on other types of boards, and I have found I'd love for you to react to this framework that I'm about to offer. I have found that we call it the Goldilocks principle. There is often the cold porridge that I describe as people who are, I think your words were laymen or lay people. And then there's the hot porridge. There's the people who have a lot of expertise and are really desperate to share that expertise because they're so confident in their opinion. And I have found that the best trustees I've served with or board of director members are sort of the warm porridge. They bring their expertise to bear, but they don't micromanage. And I was wondering, examples or how you would react to that, or how you perceive yourself in my hot, warm, and cold porridge metaphor.
I think that actually hits the nail right on the head, honestly. I do think people who are super focused on the business tend to think of themselves as extremely smart. But I think investors who have been doing this for a long time have a lot of humility. The market makes fools of us all. And so it's sort of understanding what you know and understanding what you don't know, and sort of making that sort of judgment on how can I, be steady, examine my own biases, and move forward.
And how do you feel about the recommendations that we'll be getting from a very experienced CIO and staff, as well as some top-notch consultants as part of our overall decision-making process? Where would you weight them?
I'd weight them pretty highly, honestly. I have been a professional investor for a long time. My expertise is in fixed income. That said, I read the news about all the various different assets, different sectors, but I am not in them, right? And so you have to defer to the judgment of the professionals for the most part. Obviously, you use your own common sense when you think something is not right, and you question that, and you dig deeper, and you push back. But if you can sort of discern what is the truth, I think that will help you.
And I have just one last question, Chair Horowitz. Much of the discussion has sort of revolved around investments, which is a critical function that we play as stewards and as fiduciaries of the pension plan. But there are many other issues that tend to occupy our time in probably greater proportion than investments. And I'm just wondering, if you have any thoughts, insights into some of those other things that we do, and any, your interest in those areas.
Yeah, so I guess from my understanding, you take a look at people who are retiring, but I think a lot of it is governed by bargaining agreements in terms of what satisfies the requirements. I think looking at audit is pretty common sense. So just sort of, I do think a lot of it is common sense, but I think the hard part is the investments.
Okay, thank you very much.
Thank you, Vice Chair. I guess, any other questions? Mr. Faulkner?
I'd just like to hear a little more comment on, obviously appreciate you applying. I think your background is fantastic for the investment side. Obviously, the board role is not one of our awesome investment staff who spend their days doing the investment work. So maybe you can either say philosophy, or if you have any experiences to talk about this idea of the role of being a trustee. So I'll kind of point to the governance idea, this idea of monitoring and advising. So what would be your either philosophy on that as you work your way onto a board, or if you've had any experience to point to around monitoring or advising as well?
Yeah, I guess my philosophy is once you join a board, you have to understand what the processes are. And so you should not, from my perspective, you should not come on expecting to change things immediately. I think it's understanding how things work and slowly taking a look at what is working and what is not working and where can things be improved. But for the most part, I think, you take a slow approach to learning.
Okay, thank you. I guess I'd like to follow up a bit on the last two questions you heard. Investments are important, but in fact, the bulk of our time is spent on other issues. Today's agenda notwithstanding, we look at strategic asset allocation at most once a year. The bulk of our time is spent running a department. We hire, fire, and evaluate the performance of our CEO and CIO. We hear disability cases where various employees are making an appeal for benefits that may have been denied them. We have governance issues where we figure out how to manage ourselves and how to manage our relationship with the city, which is a separate legal entity. And we do many, many other things that consumes our time. I'm amazed sometimes how much time we spend on other things. So I did want to follow through and maybe get your sense of any experiences you may have had with some of these other areas, and or your interest and openness to serving on various committees that focus on those areas. We have 5 committees. There's an investment committee, there is a disability committee, there is a joint personnel committee, there is an audit committee, and then there's a governance committee. So
Yeah, I think I would be open to serving on any of the committees.
Mhm.
I do feel like, generally speaking, our job, or your job as the board, is to sort of provide oversight but not micromanage. So in terms of where things can be improved, you seek to improve them, but your job should also be sort of just making sure that things are running properly.
Okay. Any other questions from trustees? I don't think would it be appropriate to hear public comment at this time? Is there anyone wishing to make a public comment? We're hearing the word yes. Public commenter, you have 2 minutes to ask any questions or make a statement. Please proceed.
Hello, Chair Horowitz, I assume that's me?
I think it is.
Am I the only public?
I'm getting a nod, yes, Mr. Imamura. Please go ahead.
Thank you. Thank you, Chair Horowitz, and thank you, Brian, for stepping forward. You may or may not know, I was a 12-year trustee as an employee representative to the Federated Retirement Board. And if you are chosen, which I hope you are, and hope you will be chosen, I hope to reach out to you and hope you reach out to me and you can have some discussion. I've been unsuccessful in meeting with any of the other trustees, so hopefully you're going to be more transparent and forthcoming. But anyway, just whatever my comments are worth, I think you're highly qualified. I would feel as a retiree very comfortable in you representing as a representative of one of the trustees. Your educational background is fantastic. And I reviewed both of the applications, and to me, hands down, you are the most qualified, and I hope the rest of the board sees that way as well. So again, thank you, Mr. Chi, for coming forward, and hopefully you're going to be sitting there next month. Thank you. Thank you, Mr. Chair.
Thank you, Mr. Imamura. So at this point, I think it is prudent for us to hear from the other applicant, and that is Mr. Nakagawa. If he is here.
He's outside.
He is outside, oh, okay. Welcome, Mr. Nakagawa.
Good morning.
And as I addressed the previous contestant, we have to do this process in open session in front of the cameras. It's a very unusual way to interview, do a job interview, so I have some sympathy how awkward that would be, but it is a requirement of the Brown Act, so hope you can bear with us as we execute this public process. So I think if you would like to make a brief opening statement about yourself and your interest in this board service, and then we'll have some of the trustees ask questions.
Sure, absolutely. Can you hear me okay?
We can.
I'd like to say a good morning to the board, to Vice Mayor Foley, and to the Office of Retirement staff here. Thank you for this opportunity. Just a little bit about myself from a professional private sector standpoint. I have over 20 years of experience in retail IT. Worked for multiple different companies. My two biggest ones were with ABC stores in Hawaii. If you folks have been to Hawaii, they're a big local retailer. I led the process to deploy point-of-sale systems in their retail stores across the chain. And the other big piece I did on the private sector side was I worked for Apple for about 14 years. I was very fortunate to get that job. I started before the first Apple retail store opened, and I led the team that opened retail stores worldwide from a retail IT perspective. That gave me a lot of experience on the managerial side, on budget planning, forecasting, procurement, and definitely on the HR functions. I led a team of about 50 people that were stationed in various places worldwide. For my public sector experience, I have about 4 years and change between two municipalities. I've worked for the city of Sunnyvale, for about a little less than a year as a benefits analyst and a HRIS analyst. I've also worked for the city of San Jose, where I'm currently employed. Initially worked for the Department of Transportation as a recruitment analyst. I did leave the city for a bit, but I loved it so much I came back. Again, I returned back to the city, spent some time as a recruitment analyst in the central HR department. Following that, I moved back to DOT, kind of my home, as a recruitment analyst. Stayed there. I got promoted, fortunately, to a senior analyst position where I led the training efforts for the department, as well as continued my recruitment and HR duties for the team. And in October about 2023, so about a year and a half ago, I was fortunate to get promoted to the Environmental Services Department, where I've been ever since. I'm a program manager for the Employee Services team there. I oversee the professional development training team, as well as the HR team that is responsible for recruitments and various HR functions for the department. And overall, I love the city. I've been very fortunate to work for two of the larger departments in the city, DOT and ESD. I've also had ample time to spend with multiple other departments while I was at Central HR. I got to support OED, housing, police, DOT, and ESD during my time there. So I feel I have a good connection with the folks in San Jose, the employees in San Jose. Also, about a little over a year and a half ago or so, I joined the board of CAMP. CAMP is one of the chapters of IFPTE Local 21. I'm a board member there. That's a great opportunity for me, again, to connect with union members in CAMP, as well as other members in other IFPTE Local 21 chapters, including AMSP and AEA. On the personal side, I graduated from UCLA many, many years ago with a math degree. I lived in San Jose, or been living in San Jose for about 20 years. I love San Jose a lot. Have a little bit of an entrepreneurial side to me. After my long stint at Apple, I took some time off. I decided to take a different path. I started a couple of LLCs. I started one in Michigan. The purpose of that LLC was to invest and to basically flip rental properties there. That one is still there. I just use it for passive income at this point, but back in the day when I had time, I did use it to flip houses out there. That was quite an experience. I had to learn everything from scratch, planning, tax implications, managing things remotely. It was very exciting, very fun. Made a lot of mistakes, but learned a lot along the way. Also opened a second LLC in California. That one's a little different. I wasn't working at the time, so I was looking for something to do. So I converted my my IRA to a self-directed IRA and then attached that to an LLC so that I could leverage the funds in my IRA to invest in alternative investments. So I did a couple of things there. I used it mostly to invest in undeveloped land in parts of Texas. And I still have those. Those are passive income investments, but without doing all of those changes, I wouldn't have been able to invest in those type of investments. So I'm kind of keen to, sort of the alternative modes of investment there. And on the personal side, as it comes to investments, I've been basically investing in stocks for, I'd say, about 30 years or so. I've done stocks, bonds, mutual funds, ETFs. I've invested in precious metals, gold and silver. Still do crypto. And as I mentioned, I have the undeveloped land investments. I also have done a few pre-IPO stock investments. Probably my favorite one so far has been Palantir. And also am part of a group that invested in a hotel out in Monterey. It's one of the Hampton Inns out there. And one other bit, about a few years ago, I was fortunate enough to join a local nonprofit called Silicon Valley Options Group. I was there for a little over a year, but they did have me as their treasurer and a board member of their board as well. So I did get to serve at least 1 year on a nonprofit board. That was a good experience to kind of learn how that worked. And again, they taught me a lot about options trading and other things like that. So,
okay, thank you. Thank you so much. I'll turn it over to my fellow trustees. Are there anyone who would like to forward a question?
I can go with the question that I asked before.
Okay.
And thank you, Nathan, for applying and attending all the meetings that you've attended already as an observer here. I have kind of a two-part question, which, as I've indicated, impacts me as well as you. As a trustee, you will have the fiduciary duty of loyalty to the members of the plan and will not be representing the city, just like I am not to be representing the retirees. Is that something you are aware of? And do you think you can exercise independent and unbiased judgment, not influenced by the interests of other outside the board, even in politically difficult situations?
Yes, thank you for the question. I do believe I understand that is the role, and I look forward to that if I am selected. I think again, I've been fortunate to have worked for two of the larger departments in the city. I've connected, and through my connection with the union, I do have interface with a lot of people in a lot of departments at a lot of different levels. One of my roles as a program manager for ESD is I have to lead investigations for the department. Why I bring this up is because it requires me to remain as objective and unbiased as possible. Again, these are investigations into disciplinary actions and whatnot, or performance management issues against folks that sometimes I know and work with. So I'm accustomed to having to be in that kind of mindset where sometimes you have to make hard decisions. Again, you have to base it on facts and things you've collected, and it's not always popular, but you have to do what you believe is the right decision there. So I believe remaining unbiased and objective is something I have to do every day as part of my regular job. So, if I'm selected for the board, I believe I can carry on that same mentality as well.
Thank you.
Thank you. Any other trustees? Trustee Abbott, please.
My standard question, which is, why are you interested in being part of this board, and what do you think you can uniquely contribute to it?
For the first part, why I want to be part of this board, again, kind of on the personal side, like I said, I've always been investing, at a smaller level on my personal side for many years. Retirement is a big deal. Like I said, I was with the city for a little bit. I had to leave because I was in a temporary position, but I did actually come back to the city. I love the city of San Jose. It's the reason I came back. And, the retirement is a big deal to me. And I think it's a really big deal to employees and obviously retirees. But for me, having connected with such a wide number of employees and staff and whatnot here, I understand that is one of the biggest benefits of being an employee here. So, whatever I can do to kind of represent the needs and the wants and the views of the folks and, bring that to the board, I think that would be great, not only for me, but for as many folks, employees in the city as well. In terms of what I can bring, again, I think I bring a unique perspective. I have both, an extensive private sector background, but also a public sector background as well. Like I said, 4 years in 2 different municipalities. In my role, mostly with the HR and the union, I do connect with a lot of employees, maybe more than most people. And, that gives me a unique perspective as I can kind of collate and collaborate with large groups of people and gather feedback and hopefully, again, utilize that to help with decision-making processes for the board.
Thank you.
Thank you.
Over the next few years, what do you think are the main issues that the board needs to deal with?
Oh, I'm sorry?
Over the next few years, what are the main issues that you believe that the board needs to deal with?
Over the next few years, I think it's probably a couple of things, but my belief, the biggest one is still closing the gap on the unfunded liability. I know from attending the recent meetings, we're trending the right direction, but market conditions are obviously quite volatile now. So I think for the board's role of asset allocation, it's important to stay vigilant, right? To keep an eye on it, make sure our assumptions and expectations, forecasts are all still accurate. Obviously, they've been audited, so we know that they're legit and as good as possible. And again, continue to monitor the market and the direction. Also, we need to monitor the vacancy rate with the city, right? Because with changes that are happening in the economy and the budget shortfall, if vacancies suddenly rise or increase, that's going to reduce contributions. That's going to be another factor that's going to increase the unfunded liability. So I think, again, just keeping an eye on that, I think, is probably one of the foremost things we should do. And again, look for opportunities on ways to kind of do more with less. I understand, we have to, look at allocations that will provide us the maximum return while not increasing risk as well. So.
Okay, thank you. Any other trustees?
Yes, I'll go ahead, Honorable.
I'll go last. I'll let the people who go first go.
Okay.
Yeah, I guess my broad
Trustee Faulkner.
question is, it sounds like you've done a little bit of work with boards and whether they have the exact same expectations as to what this board would see. I'm just curious about your philosophy, and you could probably speak to some of your experiences too, but being on a board, what roles and what the importance of those roles are, maybe specifically regarding monitoring and advising, and any experiences or skill sets you feel like you bring to the table in those ideas?
From a monitor and advising perspective, I'll refer to my position as a board member on the camp union. So for that one, of the members on the board there, I'm the only one with an HR background and an HR experience. I think from that perspective, when there are like labor relation related type of issues, which the unions deal with quite often, they do lean on me, I guess, for my perspective, my experience, my knowledge. I do work, again, very closely with OER. I probably communicate with OER on a weekly basis for various things related to investigations, performance management, and for policy inquiries. So I think as it relates to this board, I can, again, definitely contribute my experience, my knowledge in that area to help with anything related to those areas. Those are familiar to me. Those are part of my, say, my city day job. So I would hope to be able to, again, advise and mentor or at least provide insight to the board in those areas.
Okay, thank you. Vice Chair Chandra, it seemed like you had a question to ask?
I did, and maybe our council can clarify if I can ask about this, because I don't know if it's a Form 700 thing, but there were some investments that I wanted to ask about.
You're open to ask about them.
Okay, great, thanks. You mentioned some of the, thank you, first of all, sorry, and nice to meet you. You mentioned some of your investments, real estate investments, flipping houses. Was that within the city of San Jose? And just wondering if, having active business within the city might be something you need to consider vis-a-vis conflicts of interest.
Yes, for my, as I mentioned, one LLC is in the state of Michigan. All the properties I have are in the state of Michigan. I also do own properties in, or investments in Texas as well. As far as your specific question, anything within San Jose, I don't actually own anything in San Jose itself, or even properties in, other than my own house, but no investment properties in California. And I do, in my current role, I do have to submit a Form 700 as well, so.
Okay.
It's a privilege.
Indeed. All right.
Good question.
Any follow-up to that, Vice Chair Chandra?
No.
Okay.
Thank you for the answer.
Okay. All right, thank you. I guess it's down to me. I have a couple of questions, maybe on a similar vein, and similar to what Trustee Linder asked. You are a board member at CAMP, one of the city unions, and while we serve the members who are city employees and the unions advance the interest of city employees, sometimes our interests may diverge. That is, the fiduciary duty of the plan is to make sure that the plan has sufficient assets to pay out our liabilities. For instance, it may come about that we would consider lowering the discount rate, which would increase the amount the city must pay towards the pension. And that would decrease the amount of money available at the city budget for employee hiring, employee raises. So how would you balance your duty as a CAMP board member with your duty here as a pension board member?
That's a good question. If I am selected for the board, this board, I believe personally, my duty to this board would be of a higher priority for me personally, because I am representing employees for the entire city, whereas for the CAMP board, I am just a board member for the CAMP union, which is just a subset of the city. So in terms of impact and breadth, obviously this board has a larger impact, and it's of greater importance to all employees in the city, whereas again, like I said, CAMP is just a portion of the city. In terms of making hard decisions, absolutely. Looking at the past history, I'm sure before my time, right, going from tier 1, creating the tier 2, that was probably a very big and contentious situation for the city. And if one day we come across a path where we do have to make hard decisions, of course I understand both sides. I understand people will not like that, but again, I've been in a place, specifically with my experience on investigations and whatnot, you have to make hard decisions. You have to sometimes support the unpopular decision, but if it's the right thing to do financially, again, to protect the pension fund, that's the decision I would support.
Very good, thank you. And on a similar note, this board, it's not all about investments and returns. We spend an awful lot of time on many other things, evaluating executive performance, setting compensation for executives, hearing disability claims, looking at actuarial issues, looking at governance issues, our relationship with the city. We have 5 committees, and all trustees would be expected to serve probably on multiple committees. It's a big time commitment, by the way. So we have an investment committee, a joint personnel committee, a disability committee, a governance committee, and an audit committee. Are there any of those that you feel a particular affinity to or interest in, or a particular knowledge base that you would bring to service on those committees?
I actually do. And again, if I am fortunate enough to be selected, I would have to ask you folks if I could do it. But in my current role as a program manager in ESD, I do work with the Office of Retirement Services. It's a small thing, but on disability retirements, I do produce the usual and customary memos as requested. So I do have some familiarity. I have worked with various folks on the team here about that. If I do have a lien, I've also had to manage workers' comp claims and whatnot for the department as well. So if you're asking where my kind of lien would be, I would want to, if I could, work on the disability committee. That's something informationally I have had to do for my job here, and I do have some knowledge and background. Like I said, I've worked with ORS on some of the issues with that before.
Okay, very good. I guess at this juncture, unless there are any other trustee questions, I'll open up if there are any public comments, either online. There we do have an online comment. Anyone else present who wishes to speak? So we'll go to the online comment. Commenter, you have 2 minutes.
I assume that's me again?
That is you, Mr. Memori. It is indeed.
Thank you very much, and thank you, Mr. Nakagawa, for stepping forward, but I will again reiterate my previous comments regarding Mr. Chi. I believe he's by far the most qualified. And of course, Mr. Nakagawa, that doesn't say you're not qualified. When I first got on the board, I was 12 years as an employee representative in the city. I was twice president of the largest union in the city, which was the Municipal Employees Federation, and understand, some of the ins and outs of any possible conflicts, which there was none as far as I'm concerned. My allegiance was to the taxpayers, to the current beneficiaries, and of course the current active employees. So anyway, and Mr. Horowitz, I just wanted to piggyback on you certainly articulated the duties of the prospective trustee, and they have other duties aside from investments. And I would just want to point out that, and I think CEO Mr. Flynn has made a good effort of getting the staff back into the office, back to work. I've always viewed as work at home as an oxymoron, if you can understand that. Hopefully you do. And I know you all have, I don't know if most of you are even listening to what I'm talking about, but anyway, again, I want to extend an invitation, and again, who's ever selected, although my preference is Mr. Chi, of course. Hopefully they will reach out and have a meaningful conversation with the people they're supposed to represent. And as always, Mr. Horowitz, you've been very gracious, and thank you for the opportunity to speak.
Certainly, thank you, Mr. Imamura.
We have one more comment.
We have another comment? Okay, please go ahead, commenter. You have 2 minutes.
Hello, everybody. This is your former trustee, Julie Jennings.
Figured she might jump on.
And this position that you're looking to hire is the replacement for what I've done. I just want to say that I think both candidates are highly qualified, and I think it's outstanding that they have both taken the opportunity to apply. It's a very difficult, application process, and it does take a lot of time to do this job. One has a lot more investment background, one has a lot more city and HR background. And I think Chair Horowitz has, as asked some very pertinent questions about the overall perspective, per se, for this role. It's a holistic and it's broad, and it is where the priority is for the people who will be taking advantage of the pension, such as myself now. So I think you're all very talented and capable to look at the alternatives and see what will best fit your needs. I think, as I said, both are good candidates, and it's what you're looking for to fill this. I think either one of them will do a great job. I think City Council will be happy with either one. So I look forward to your vote, and I will leave it in your competent hands.
Well, thank you so much, Vice Chair Emeritus Jennings. Are there any other public commenters? No. No more comment. All right, it's down to the trustees to make our decision. And this, thank you very much. I'm sorry. Thank you very much, Mr. Nakagawa. I think we do have two very qualified candidates. Actually, my own preference would be to have them both sit on the board, because we need more trustees to cover all the committee assignments. So if we could do that, I would do that. I'm assuming Maytag, we can't do that.
That's up to City Council.
Okay. And I guess our consideration of this also takes place in open session.
That's right. The deliberation is done in open session, and then the recommendation is based on a vote that the board takes for the recommendation to be forwarded to City Council.
Correct.
Council,
Okay.
yeah.
All right, so I'll open it up to fellow trustees if they have any comments, thoughts, preferences, insights.
I can get it started if that would
Please.
be helpful.
That would be helpful.
Thank you, Mr. Chair, and I do appreciate the two strong candidates that we have. What's interesting to me is we also, both from Anurag and yourself and others, that the bulk of our work is often not investments, but administration. And I was impressed with Nathan's background in administrative work, everything from private sector to various departments to Sunnyvale, which is a renowned, well-run city. San Jose, all those departments are strong. I know those departments, they've been well-run. But he has the experience in stuff that we wrestle with here. We have strong investment board members. We have, the two from San Jose State. We have Anurag. We have you, Mr. Chair. My experience in San Jose was in the upper management level. We have our accounting audited person over here, but I think adding him would be added a side of experience that could be very useful for us. And I don't mean to diminish at all the experience and what the qualifications that Mr. Chi would bring. It's just I'm looking at the mix of the board and what would be useful. And I think Julie was able to do a good job, even as a member of the camp board, protecting her fiduciary responsibility here. So, but what I am most impressed with is the diversity of background in the administrative issues that we have to wrestle with more often, many times. So that's my feelings, and I'll finish there.
Okay, thank you, Trustee Linder. Anybody else would like to opine? Trustee Abbott, please.
Yeah, I have to agree with what you just said, Trustee Linder. I think if we only had Brian applying, I would be really excited to have him on board. But I love the breadth of experience that Nathan has had, and the fact that he can bring in a more diverse perspective, and we do so much more. When I joined the board, I thought we did a lot on asset allocation. That was the most important thing. But what I've learned since then, and how much more important it is with the things we do with audit, and the things we do with governance, and what you guys do with disability, and the issues we've dealt with have been, we have such an excellent set of advisors, and an excellent CIO in terms of our investments. It really feels like where we add more value is in some of those other things. So I would really support Nathan.
Okay, thank you.
I agree with what both of you have said, but I do feel that coming to this board, it takes a lot of efforts in understanding investments and actuaries, and that's really like a lot of time that we spend on the board. So having someone coming from not an investments experience is kind of like that will take them huge time to understand all those things. So I feel like having investments experience is not like nice to have, but it's must have. Even though I came from investments experience, people have like now marked me as audit and accounting, which that was not my experience in the past. So even if someone is coming from investments experience, they can switch on to other things. It doesn't mean that they cannot take on the administrative work. So that's why I'm more lean towards Brian than Nathan, because that learning curve on understanding and sitting through everything that we discuss here will be easier for him as compared to Nathan.
Vice Chair Chandra, I know you may be time constrained, so I'd like to offer you a chance to speak.
Oh, thank you. I agree with the comments that we have two strong candidates and we're fortunate to be in that position. I guess we could use apples and oranges, but for me that's grape versus cherry, because those are my two favorite flavors of Italian ice when I go to the beach in the summers in New York. So, and I love both. On certain days I'd want grape, and on other days I'd want cherry, and I have to figure out today which one I want, because I'm sure tomorrow would be different. They're both equally qualified, and I really want to stress that. In the past, I've served, 9 years. There have been other trustees who've been asset holders like me, which is different than cash management or being an academic or being an enthusiast. And I've at least with prior trustees, found that to be really valuable because when you sit in that hot seat and are accountable to shareholders, stakeholders, or limited partners, it really shapes your sense, and I think it's far more analogous to what it's like to be in Prabhu's seat or his investment officers. And that would obviously, favor Brian, since he's had, although his experience is more in fixed income, which isn't necessarily considered a risk asset, and risk is probably the thing we most have to worry about. In strategic asset allocation, he's worked at Blackstone, and he's got just terrific background and experience. But there is this other side of the ledger that Mark spoke to rather eloquently, and I think Debbie as well. Julie didn't have much investment experience when she joined and was a fairly quick learner. I even feel like with the experience I had managing $2 billion in private assets before I got to the board, that I still drank from the fire hose. So I think that tends to be a natural evolution for just about everybody. But there are some of these other attributes that Nate brings that are really valuable. And hey, I'm going to say it, someone who's willing to volunteer for disability already has me kind of leaning forward. So I wanted to make those remarks on behalf of both candidates. They're both strong. What might be perceived as a weakness in one, I think they could cover fairly quickly, and what might be perceived as a strength in one, I think the other could cover fairly well. When I say quickly, in a year's service, drinking from that proverbial fire hose. If I had to lean in one direction or another, I agree with what Debbie said. We've got a great CIO, we've got great staff, great consultants. Our program really took a turn in 2018, 2019, and has been sort of steady. We've adjusted the altimeter once or twice, but I think there's more work to be done in some other areas. So I might just, as a 51-49 call or 55-45, throw my hat with Nate.
Okay, thank you. Yeah, clearly both candidates are enormously qualified. We'd be lucky to have either one. Their particular backgrounds seem to be complementary to each other, so it would be great if we could merge the two of them into a single unit. which doesn't seem physically possible. I think Trustee Avasti does bring up an important point. There is a fire hose of information to absorb, and some of the most challenging stuff to absorb and master are the investments and the actuarial information. That is a challenge. So that speaks to readiness on day one to take on the roles. So I guess at this point, and obviously Mr. Nakagawa's background, broad background, brings insights about city operations that we would otherwise may not have. Is this a vote where we're taking a motion and a second, or we're simply going to have a direct vote on the two candidates?
You would have to designate the candidate, just kind of like how we do for the chair and vice chair positions. You would designate the candidate for the vote and then take a vote on it. There can be a substitute motion if there's, competing motions. That's also a possibility.
Okay.
In the instance that there is a substitute motion, the substitute motion will be voted on first, then the original motion will be voted on.
Okay, so it's a motion with a second.
That's correct.
All right. Well, with that in mind, I'll invite any of the trustees to make a motion.
So I would move, Mr. Chair, that we recommend Mr. Nakagawa to the city council to join our board.
Very good. A motion from Trustee Linder. Do we have a second?
I'll second.
We have a second from Trustee Abbott.
I would like to make a substitute motion
Okay. Trustee Avasti?
for Brian.
For Brian. Do we have a second for Brian? In the interest of making this a horse race, I'll second that motion. So we have to take the substitute motion first, is that correct?
That's correct.
Yes.
Okay, so we will have a vote on the substitute motion, which is to forward Brian Chi as our candidate for the open trustee position. And this is a roll call vote, so we'll go first to Vice Chair Chandra.
And this is for.
This is for, this is for Chi.
Okay, I will vote nay.
Trustee Avasti?
Aye.
Trustee Abbott?
Nay.
Trustee Faulkner?
Nay.
Trustee Linder?
Nay.
And I will abstain. So now
That motion fails.
that motion failed. Now we move to the original motion, which was for Mr. Nakagawa. Same procedure. Vice Chair Chandra?
Aye.
Trustee Avasti?
No.
Trustee Abbott?
Aye.
Trustee Faulkner?
Aye.
Trustee Linder?
Aye.
And I will abstain. But I believe the vote carries.
Hold on a second. So I voted for yes. I got Chandra, Abbott, Faulkner, and Linder. Is that
Correct. That is correct.
That does pass.
Very good.
So it goes to the city council, I take it.
Yes.
So just from a process perspective,
Mhm.
we will draft a memo from the boards, from the board to city council. It'll have to go through rules to determine which agenda it will make on. And once I have that, I'll share that with the chair and also the candidate. So they, I believe the city invites both candidates, but
Oh, they're going to invite both candidates to
I-
speak
I-
at city council as well?
I don't, it can be on consent as well,
I
so
see.
it's really
It can
determines
go
on.
either way. The
That's right,
council could do an interview, or it could be on consent.
correct.
That's
I
right.
see. You have a question,
Just
Mr.
quick,
Faulkner?
I believe Trustee Jennings left kind of like midterm, so how does this work procedurally with that? Does it fill in that gap, and then is there a
Correct.
reprocess, or is it
So
reset at time?
there is an unscheduled vacancy process as compared to a scheduled vacancy process. And so because Trustee Jennings was more than 12 months away from the expiration of her term, it's to fill the remainder of her term, which I believe is November 27. So whoever the city council approves would be filling it until then, in which case they'd have to go through a normal election process.
And I think that's similar for me, because my renewal will be a year from
Then
now,
we do this all
November
over.
2026.
Okay. All right. Are Mr. Nakagawa and Mr. Chi still here, or should we inform them of the result, or just let them watch it on the game tape?
Just check to see if there's.
He's looking around like, who's here? All right, I guess we can proceed to the next agenda item. Of Great, and that is item 6D, discussion action to authorize the CEO to execute a lease agreement.
Okay, can I make a motion that we give him that authorization?
Okay, you don't.
I'll second that motion.
Okay.
Because we went through it previously, so it's not as if.
This is not a new thing, yeah.
Okay.
There was a modification for the price.
Yes, so just a quick update. The rent that we are negotiated to is $2.75 a square foot, which is a over 16% reduction in our current cost per square foot. There are a whole host of other terms, but that was the majority, that was the driver.
Okay.
And the increase in square footage is the same as last reported?
Correct. It's just over 2,200 square feet of new space, and so the net is a slight monthly increase.
Okay.
Okay, so we have a motion from Vice Chair Chandra, second was Trustee Linder. Any further discussion from trustees? Any public comment? No comment, so we will vote. Vice Chair Chandra?
Aye.
Trustee Avasti?
Aye.
Trustee Abbott?
Aye.
Trustee Faulkner?
Aye.
Trustee Linder?
Aye.
Chair votes aye. We are leased. Item 6E, discussion action on an RFP for legal services for our disability and domestic relations attorneys. Would you like to put this?
So I'm happy to address that.
Okay.
The ad hoc legal services committees, the joint ad hoc committee for legal services we met after the staff did scoring for all the services, but specifically for DRO and disability. There was a clear winner in Saltzman and Johnson. Staff overwhelmingly recommended them across all the categories, including cost, and recommended to the ad hoc committee that we bring it straight to the board. And we are on agenda today for a 6-year term for a not to exceed amount of $505,000.
Okay, and just for clarification, Saltzman and, what's the name of the firm? Saltzman and Johnson. This is the firm of Russ Ricada.
Correct.
Who
Our
the
current-
board has worked with.
Oh, okay.
Okay, so that's who that is.
Our current provider.
Mhm, okay. So are there any trustee questions about this item?
We had a subcommittee working with you on this?
Correct.
This is a joint ad hoc
Right,
between us and the police and fire.
okay.
Okay, if there are no questions, no public comments,
I'll move that we approve the recommendation.
we have a motion from Trustee Linder. Do we have a second?
Second.
We have a second from Trustee Faulkner. Any further discussion on the motion? Hearing and seeing none. Vice Chair Chandra?
Aye.
Trustee Avasti?
Aye.
Trustee Abbott?
Aye.
Trustee Faulkner?
Aye.
Trustee Linder?
Aye.
Chair votes aye. They have a contract. On to the committee reports. 7-1 is Investment Committee. We can receive and file the minutes from December 11th, but if our committee chair, Chandra, would like to comment at all about the last IC meeting?
We really recovered a lot of it through the capital markets conversation that we had today. The only other thing that came up in joint session with the police and fire is some discussion around reviewing the IPS, which is good governance hygiene, since it should have probably been done a year or two ago. I think we're going on to year 7, Prabhu, with that. Yeah, probably, you want to look at it every 5 years. So that process will begin with our brethren, police and fire.
Okay, great. And as I said, we're going to receive and file the minutes. On to the Audit Committee. Go to Audit Committee Chair Avasti, as much as she may resist the role.
A lot of work here.
So we have the minutes for receive and file. The last meeting was on February 20th, where we nominated and elected Trustee Abbott as the Vice Chair of the Audit Committee. And then we have a couple of other items here as well. One is the status of the outstanding city auditor's recommendations. So we have 2 items here. One is the status and the other is an action item on the same thing. The only difference is One status is as of December 31st, 24, which is basically the report that the city auditor will be submitting to the council in March. And then we have the current status on the same recommendations. There are 4 recommendations on the city auditor's report. As far as the current status is concerned, 2 of them are already implemented, they are addressed, and 2 of them are in the pipeline, and they are expected to be implemented in April.
Right, there, for the 1231, we reported them as partially implemented. So in progress.
Okay.
And then I think we had an elaborate discussion on the senior internal auditor position. This was discussed in the last audit committee meeting. I would just like to add to that there is an inclination of the audit committee, as well as on the recommendation on John, to outsource a function of risk management to an external consultant. So John will be working on an RFP to get that consultant because we do need to fill in the shoes of the senior internal auditor, and that's how we are inclined to proceed.
Is that meant to be a temporary outsource or permanent outsourcing?
It would be permanent in lieu of having a senior auditor position.
Internal, okay.
And just to note that there is a budgetary implication there, so it would require budget to do the outsourcing of the auditor. So while we will start the process before July 1, we wouldn't be able to execute the contract until at least July 1.
Okay.
And then the last item here, which is a discussion on action on the status of outstanding internal audit recommendations. We had a fair discussion on this item at length. So if you look at the status of the prior internal audits, there are 85 audits in total, of which I would say almost like 50% of them are in process or not started. So the audit committee gave a direction to John and his staff to come back with a prioritization of those recommendations and based on criticality to the board. So I'm expecting that will be done in the next audit committee meeting. Anything else that, John, you would like to add?
No, I think you covered it well.
Okay, any questions from trustees on the audit committee? Okay, any public comment out there?
A lot of good work, thank
Yeah.
you.
Yeah, I just wanted to point out a format change in how we're presenting this in the agenda at the suggestion of our CEO. All these bullet points under A, we used to list those as separate letters under 7.2. They're not actually action items for the full board, so we were listing them as bullet points, as an aid to memory for the committee chair to speak to, and only action items that the full board has will have a subletter A or B designation. So that's how we're going to handle that in future agendas. So on to 7.2B, which is file and receive of the minutes, and we're going to do that. Which brings us to the governance committee. Oral update from the chair, Mr. Linder.
Yes. So our meeting on March 14th was a joint governance with the police and fire. And not wanting to have Trustee Abbott having nothing to do, we also named her as vice chair of that committee. So thank you, Debbie, on that. We spent the bulk of our time interviewing candidate firms to be governance consultants to the board. And we interviewed the 3 finalists. A lot of work had been done by Barbara in particular in kind of getting the material organized and figuring out we had more than 5 applicants to get down to 3. And coming your way will be a recommended contract with Aon Consulting, Inc. to be our new governance advisors. It was unanimous on both sides of police and fire and us. And for those who were involved in the interview process for our CEO, the number 2 candidate behind Mr. Flynn is with the Aon Corporation.
Oh, okay, well, that's interesting.
So we kind of get, plus they're, both of them showed up. Both representatives of Aon showed up. it was clear that they have a strong firm, but that they were going to really put some energy for us. All the firms are very capable, but that was kind of, we leaned in that direction. And that just happened to be an extra plus, having her involved, but we were happy with the others. So we don't have an official contract yet, that's being worked on, but that'll be coming your way, just so you know that.
Okay.
And you'll see all the groups are strong, but I think this one fit best for us.
Okay. Well, we look forward to that recommendation. I guess we're going to see that on next month's agenda.
We're working to bring that for April.
Okay, great. All right, then we need to receive and file the minutes, so we will do that. I just wanted to make a note that I'm informed that Vice Chair Chandra has left the meeting, but we still have quorum, so we will proceed to item 7.4, which is the Disability Committee. Again, Mr. Linder, we had last meeting February 4th. I think that was prior to the last board meeting, so you've had.
Yeah, we're still working with staff on when we have our next meeting.
Okay. Joint Personnel Committee, we're going to meet April 2nd. We haven't met in some time, but we do have an obligation to meet every 6 months.
It's our 1-year anniversary almost, isn't it?
Yeah. And then we have 7.6, Legal Services Joint Ad Hoc Committee. Oral update from that committee. I believe Trustee Abbott, you'll need to speak to that.
Okay, well, I didn't bring anything to speak to, but
Okay.
I will say that we did interview, we had some, two really good candidates that we looked at in terms of where we wanted to go with regard to general fiduciary, and we've come up with a recommendation. And are we ready to talk about that?
So it is a recommendation of the committee. We're formalizing the recommendation memos that will go to the boards for next month. You're happy to discuss it if you'd like.
Yeah. So we thought we had two very good candidates in our final selection. We looked at some other candidates that had applied, and I'm happy to say that we are recommending that we continue with Reed Smith for our general fiduciary.
Oh, okay.
I can talk to the other services. So we also have so today you approve the DRO and Disability Council. So that's two of the six. You heard about another two of the six from Trustee Abbott. Tax Council was interviewed by staff, and we are formulating a recommendation as well. And Investment Council was interviewed, I think, last Tuesday with me and the majority of the investment staff, and they are formalizing their recommendation for the two finalists, but those still need to go back to committee before they can come to the boards. And so I don't want to get ahead of the committee.
Okay, great. I'm glad to see that we have multiple serious finalists in all categories. So that is
That's really good.
That is very good. Compliments to the staff for inducing applicants for these positions. Well, wasn't always the case, so we can't make assumptions there. So then we're on to Actuarial Services Joint Ad Hoc Committee. And how are the candidates shaping up over there?
Yeah, we have made significant progress. I believe we have selected the actuarial services, so there's no change as far as actuarial services are concerned. We are still retaining Chiron.
Okay.
And then on the actuarial audit services, the staff is interviewing the candidates.
Okay.
We're
Is there
scheduled.
any update on that?
Yes, I think we're scheduled to interview April 1st for all of our actuarial audit. We have I believe we're interviewing 4 candidates as part of that process. And just as a note, we plan to bring the recommendation from the Actuarial Services Audit Committee to the boards also in April. So you can expect to see in April a number of requests to negotiate and execute contracts as the result of all of these RFP processes.
Excellent. And we did have multiple serious bids for the actuarial services.
Yes.
Okay, great.
We had five total.
5.
Chiron was by far and away the
Leading candidate.
favored based on the scores. And so we decided to bring that directly to the board, and, but we will interview the remaining finalists for the audit services.
Okay. Great, thank you. On to item 8, education and training. You have before you a number of educational opportunities. Proposed agenda items, are there any? Any public comment on this item? Seeing none, this meeting is adjourned.
Well done.
Thank you.
Mr. Chairman.